When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
Live from New York City this morning. Good morning on TV and radio. Here's the price action this Friday. Going into payrolls 2 hours away. Equity futures down about 0.2% on the S&P. On the NASDAQ down around about 1/3%. It has felt really bad this year because it is really bad this year. Bank of America out with this stat. 77% of the NASDAQ already in a bear market. That's just the carnage, the destruction already taking place beneath the index level. It's felt terrible this week, but if I asked you to guess where we were, would you guess that on the NASDAQ 100 we were flat on the week? Negative just 0.03%. Maybe you wouldn't get to that number. That's the equity story. Here's the bond market picture for you. 2s, 10s and 30s. 5s all the way out to 30s. Every single point trading through 3%. Your 10-year, just short of 3.1%. Yields up 4 basis points today. Over the last 5 days, up 15 basis points. That's been the surprise for me of the last few months. We were all talking about flatter curves, curve inversion. Since March, it has been pretty relentless, and it's caught a lot of banks and strategists out. Your 30-year, 3.16. I want to talk about foreign exchange as well. Euro, dollar, and pound sterling. Cable with the biggest one-day fall yesterday, going all the way back to 2020. We looked at a 122 handle a little bit earlier, 123 right now, 123.53. And the fear the ECB has is the Bank of England, Lisa, in the ECB's future. Just looking at the growth forecast, the inflation forecast for the Eurozone, and ECB official after ECB official coming out and talking up the prospect of higher interest rates.
Is there any way for them to avoid hiking into weakness? And honestly, that was what the Bank of England had to do. Yes, it might be more extreme than the ECB, but the ECB is going to have a very similar type of move coming up.
And if you want to find a split right now, Lisa, just ask the FX strategists. Are higher rates from the ECB Euro positive or Euro negative?
It's a great question, because at this point, if they raise rates, does that slow growth and just lead to an even lower euro? And that seems to be what a lot of people are seeing, at least in the near future.
TK, euro dollar right now, just short of 106, 105.
Yeah.
93.
Yeah, Eurodollar's given us some stability here. Maybe it's the one pivot point we've seen. But, John, I want to go back to sterling. To be clear here, folks, as you wake up across America, I think as a general statement, John, sterling doesn't have a bid yet.
Sometimes honesty at a central bank can get you into trouble. We criticize them for not being honest enough. I think Governor Bailey was pretty open and transparent.
Well, that's the kind of guy he is.
They've got no idea what the future holds. They're not going to try and tell you they do. And there's a huge, huge division on the committee about what's going to happen next and what they should do about it.
On radio and television, we welcome you today. We're considering a 6-hour surveillance this morning. The news flow is so extraordinary, and our team has lined up a killer set of guests. Jeffrey, you were with us earlier. Andrew Hollenhorst joins now, chief U.S. economist at Citigroup, and of course his aggressive research has been out front with an aggressive rate, statement, I should say, on the Fed's trajectory. Andrew, how do you amend your call on the Fed's trajectory of rates if we see a more persistent inflation? That seems to be the question of the moment.
Thanks, Tom. Thanks for having me on. I think what we're seeing already is a more persistent inflation, which is why we've been calling for the Fed to hike in 50 basis point increments. We saw that, of course, earlier this week. We had guidance from Fed officials that will continue at least the next couple meetings. And I think the big question is really how far do you need to go? Where is that neutral rate? And that's where Chair Powell was a lot quieter at the press conference, kind of giving some indications that, yes, it could be higher. But I think the reality here is that we have persistent too high inflation. We heard Chair Powell say it will be a painful process to bring that down. So 50 basis point hikes at upcoming meetings, and how far do they go is the question.
Andrew, I was a nerd as a child, and I would sit and read economic papers. I know Lisa finds this hard to believe. And Andrew, one of my heroes, and I had the honor of speaking to him, was Axel Leonavood of your UCLA. He was a Marine coming out of the trenches in economics saying, let's go, let's get adult. Is it an Axel Leonavood moment right now?
Yeah, great person. Thanks for mentioning him. I think it's just a pivotal moment for Fed policy. I think we saw a committee, we saw Chair Powell earlier this week trying to get things right in that moment. Powell referencing Volcker, that's who he's looking back to and saying this was someone who was willing to do the right thing to bring inflation down, even when it was not necessarily the popular thing. And I think that's where the Fed is eventually going to land. I think we're seeing some kind of growing pains in terms of getting there. Will they recognize that we're really in a wage price spiral as we are right now? They're not quite there yet. But I think that's where we're going, and that's why we keep seeing interest rates moving higher.
Andrew, you're setting up your clients to expect a deceleration in payrolls growth, and you think that starts today. Can you walk us through the framework you're using for that, the way you're thinking about it, and what that looks like through the summer?
This is like so much of what is going on broadly in the U.S. economy right now, where we have really strong demand. There is no lack of demand to hire workers. We have about 2 job openings for every unemployed worker. And you're being constrained not by the demand side, but by the supply side. So we tend to look at a slowing in job growth, or at least historically, and we would say job growth is slowing down. It must be that the demand underlying the economy is slowing down. Instead, what we're seeing is the supply side basically is becoming more and more of a constraint. With the unemployment rate already so low, workers are just not going to be available to be hired into these jobs. That's why you see wages moving higher. So I think the risks are that we get, yes, the slowing in jobs growth, but the real story is going to be the risk to wage growth, with wage growth picking up further. And again, this being this kind of inflationary pressure that you have in the economy because we're just not balancing demand and supply right now.
Andrew, how are you going to use the number that we get in about 2 hours' time and parlay that into some estimate of where we'll end the year with inflation, how much it can decline, the pace this year and next?
Right, so it's really the wage growth number that I'm looking at. And what we saw in the employment cost index, which is a broader measure of wages, is employment costs that are rising close to 6% at an annual rate in the first quarter. So what I'm watching in these average hourly earnings numbers that we get monthly is, are we seeing that 6% or so rate of inflation annualized? So that'd be 0.5% or so on a monthly basis. Are we seeing that accelerating? If that's accelerating, then I think we're really in trouble in terms of bringing down inflation. The Fed would have to move even more hawkish. Or is this something that's stabilizing or coming down? Again, if you're just stabilizing, that's the point that we've been making. It's not clear to us that even though headline inflation is peaking, that underlying inflationary pressure is peaking. It's, maybe at best plateauing if things kind of stabilize, and the risk is that it accelerates further.
Andrew, I want to sit on the point that you said, where if it accelerates, if wage growth accelerates, then we're in trouble. What does that mean in terms of how this inflationary impulse compares to, say, the 1970s or historic bouts in the past?
So the situation is still better than the 70s in the sense that in the 70s we had run a long period of too high inflation. Institutions had lost credibility. You needed a really crushing recession to bring inflation down. What I mean by the U.S. economy being in trouble or being in a difficult spot is maybe a better way to say it, is that the potential for a soft landing just becomes less and less. It becomes a lower and lower probability event. We heard Powell saying, incidentally, that in principle, we can achieve a soft landing, that it's plausible we can achieve a soft landing. I think he actually called it a soft-ish landing. So there's already an expectation that it may be difficult to land softly. To the extent inflation picks up further, you may need a more significant slowdown, a more significant recession to bring inflation down.
Andrew, Citigroup owns a high ground on international economics with the work of Willem Bouter, Catherine Mann, of course, now at the Bank of England, and her profound impact yesterday. The back end of the GDP equation to me is a complete mystery and is of profound importance. Hollenhorst 101. What is the big deal if we import a ton of imports because we're America? What's the so what on $100 gajillion trade balance?
Yeah, so, I don't know that I would focus so much on the trade balance itself. Instead, I would just focus on that imports number and what it's telling us. Why was Q1 GDP negative? In a mechanical sense, it's because those imports were so strong. And again, it goes back to what we were talking about earlier. It's the demand in the economy is outrunning what the domestic supply is. So GDP is measuring how much do you produce. And you look at how much you produce and, well, Americans are consuming much more than what we're producing. And so you're importing these goods, that's pushing up prices. It's just all part of the supply-demand imbalance. So I think the kind of, near-term message from the widening trade balance is the same as what we're seeing across the economy, which is demand that is just too strong relative to supply.
Which is why you think the Federal Reserve goes again and hikes interest rates 50 basis points. Andrew, Fed Chair Jay Powell clarified that this week, essentially telling us that the next one's 50, the one after that is 50. And most people think we get to August, go to Jackson Hole and reassess the whole thing. You think when they do that, they reassess and they come out and do 50 again in September. Andrew, why is that? What is it that you expect that drives you to think that we get another one after that and they're just still not done?
So I just listen to what the Fed is telling us, and then I compare that to my own expectations for the U.S. economy. So the big place where that's differing right now is the persistence of inflation. I know that Chair Powell said months ago now that transitory is not the right way to describe inflation. But when he talks about inflation, he still talks about inflation that's coming down for kind of exogenous reasons. And in my view, inflation will not come down until the Fed tightens financial conditions sufficiently to slow the demand in the economy. And that would be nominal interest rates getting probably above 3%. We had former Vice Chair Clarida talking about 3.5%.
Yeah.
And it could even be north of there. Typically, you think that the nominal policy rate needs to get to at least the kind of underlying inflation rate. And I don't know that there's anyone right now who doesn't think that the underlying inflation rate is somewhere north of 3%. So there's kind of a sense in which we're not at any notion of the neutral rate yet, and that's what Chair Powell said. So he doesn't have to answer the question now in terms of how far we're going. But I would think that we'll at least see 50 basis point hikes until we get above 2% rates. And then, could you go further from there at a 50 basis point rate? I think that's possible.
Andrew, awesome. As always, Andrew Hollenhorst there of Citi. Back in late March, Tom, Andrew called it 50, 50, 50, 50. And it became consensus pretty quickly for a lot of people.
Yeah, it's real leadership. I mean, it's a really important call, and it's something we'll remember a year from now.
Futures, negative 1/3% on the S&P from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. The US is warning Russian billionaires there is no hiding place for their yachts. That came as authorities seized a $325 million super yacht the US claims is owned by Russian billionaire Salman Karimov. He's accused of money laundering and conspiracy. The US worked with officials in Fiji to seize the vessel. The United Nations says global food prices continue to hover near all-time highs. The crop trade has been disrupted by the war in Ukraine. The country has been one of the world's largest shippers of wheat and vegetable oil. High fertilizer prices and droughts have added to the problem. In China, top leaders have warned against questioning President Xi Jinping's COVID-0 strategy. The Politburo struck a more defensive tone as pressure builds to relax the restrictions and protect the economy. China's economic activity contracting sharply last month. And the parent of British Airways is having to slow expansion plans because of staff shortages at London's Heathrow Airport. IAG now aims to operate at 80% of its 2019 capacity this year. Seating capacity in the key transatlantic market will be close to normal by the third quarter. IAG's first quarter operating loss was worse than expected. On Wall Street, dealmakers may see their bonuses for 2022 drop by as much as 40%. Their problem may slow down in IPOs and underwriting. That's according to the compensation consulting firm Johnson Associates. Meanwhile, traders could increase as much as 20%. Global news 24 hours a day on air and on Bloomberg Quick Take. Powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Well, I think the floor is important because it keeps going up.
And so for me, trying to put a forecast around all of this, the floor for yields is higher. And it makes it untenable to expect yields to be lower anytime soon, because it's impossible to imagine yields falling whilst the central bank's hiking in the early stages.
One of the best, Steve Major of HSBC, rethinking the path forward for interest rates. That call for 150 getting difficult with 10-year rates at 3.1% right now. From New York City this morning. Good morning. Alongside Tom Keene and Lisa Bravitz, I'm Jonathan Ferro. Futures negative about 0.33%. Carnage yesterday on the Nasdaq. The Nasdaq 100 down just 0.4%. In the FX market, euro dollar just south of 106. Kit Jukes publishing moments ago saying, as for mad markets, euro dollar is where it was at the end of last week, give or take. Sterling, much weaker over the last week, Tom. Kit's words, because the penny has finally dropped. Rates are going up. The economy is slowing sharply. And despite all the volatility, the Australian dollar, Tom, is this week's top G10 currency. Would you have guessed that?
No, I would not.
I looked this morning. And,
you know, I was internalizing Kit Jukes and Arsenal, and, you know, the threat it is to the tots. And, you know, Australia's its own beast, isn't it, John? And again, this is this lockdown. John, can we state someday the lockdown may end?
Where's that, Tom?
I don't know when. I don't know the when. I mean, you know.
Which lockdown are you talking
China.
about?
I'm talking about China.
We've
what
gone
it means
from Australia to China.
Yeah, well, I think the Chinese lockdown really manages for...
Same place, China.
You know, works.
Okay, China jumps out. Why? Because this morning we've been looking at Adidas numbers. The stock's down hard. And I think this stat, if you're struggling to get a read on China, it's not a perfect way of doing it, but take a group of companies and look at their exposure to the country and how they're performing. First quarter revenue to Greater China down 35% for Adidas. That's the struggle right now.
Well, it is, and it's a super in, and again, it's a 6-hour surveillance this morning. We're negotiating with our negotiators about the huge news flow we see right now. Futures, -11 on this jobs day. Right now, we digress, and we do so with one of the great thinkers of global Wall Street, Dominic Konstam, legendary at Credit Suisse, and all are thrilled he has joined Mizuho Americas as their head of macro strategy. Dominic, I love the top of your note, and you will now justify the hope and prayer of Chairman Powell. We will go from lower for longer. You know, the whole rate move and all that, back to the hope and prayer of long rates coming in. And you say Fed action is possibly necessary and is possibly sufficient. Discuss that.
So, well, thanks for having me, Tom. The first point is that although people try and make a comparison with the 1970s inflation, this inflation is all about the supply side. And it looks very different from the get-go. It's been led by goods sector with all the shutdowns and the excess stimulus to do with COVID. Right now, the whole point of what the Fed's trying to do is to make sure it doesn't turn into 70s inflation with a wage price spiral. And in particular, that's regarding the service sector, and that's rents. And basically, if you target the labor market and weaken that a lot and make sure that wages don't really sort of gain ground, then I think there's no reason not to be optimistic that the supply side will come back and basically bring down inflation. And then the second point is look at financial conditions. I totally disagree with people who suggest financial conditions aren't tight enough. They are amply tight enough. The problem people have is they measure it the wrong way. They put the interest rate in their measurement of financial conditions, which honestly is just not the right thing to do. You need to exclude it. You need to look at spreads and you need to look at the FX. And on that basis, financial conditions are already as tight as we've ever seen them. And that's the problem.
I hate Dominic having you on. I got like 8 ways to go here. Dominic, let me cut to the emotion right now. The Hawks are out at the Hoover Institution, the land of Michael Boston, the land of John Taylor and the rest, and they're scared stiff. You go the other way. What does Dudley, what does Clarida, what do the others worried about high rates, what do they get wrong?
Well, I think what the issue that they have is they want to beat up on demand in order to make sure that inflation comes down. And I agree that there is a big uncertainty when you're dealing with supply side driven inflation. You don't know what it takes to bring people back into the labor market. You don't really know what it takes to tell employers not to pay up for higher wages. We just frankly haven't been in this situation. We haven't had something like COVID, as far as I can remember in my career. And so it's that uncertainty that everyone faces, including the markets. And the problem that the markets had yesterday with Powell was they want Powell to beat up on demand. They want Powell to basically take down asset prices even more across the board in order to be absolutely certain that inflation is coming down as quickly as they want. Basically, people are impatient, and I understand that. I get it. And I don't think the idea is that rates are going higher for longer, if you like. I think the idea is rates have, if you like, normalized to where they should be. I'm talking about the long end. But the problem they've got is they're not going to stabilize until we see the data fall the way that the Powell obviously expects it to do. And so we're kind of in overshoot territory. And when you're in overshoot territory, you don't really know how far things are going to go. And I think one of the biggest issues that people keep forgetting is it's not about the fundamentals as such in terms of your outlook. It's about where are the buyers? Where are the buyers for treasuries and what are they worried about? Yeah. And there are a lot of foreign buyers and they just want stability. They'll come back when there's stability, but they're not going to come back when there's all this volatility. And that's a big problem, I think, with stabilizing the market, which is why we're in this overshoot territory.
Just quickly, Dominique, since you do see the 10-year yield ranging from 1.5 to 3.5 within that band and not beyond, like some people say, where do you buy the risk asset dip that we're seeing that continues?
Well, I'd be more cautious on risk assets just because the overshoot for the financial conditions can obviously weaken them furthermore. And and there is a problem which if the foreigners in particular don't come in, domestics will have to take up a huge amount of treasury supply, and asset allocation is way too skewed towards equities against debts. I mean, COVID saw a massive reallocation out of debt into equity. So the scope for the equity market to trade rather poorly until we stabilize rates is unfortunately very much there. I think the issue for us is to try and find stability in the long end first. And that's going to be part and parcel, hopefully, of foreign investors being more confident that the inflation story is falling into place. And then you'll see the stability and risk assets follow. That's the way I would put it. So obviously, we're on the back foot in all of that now. But it really is down to the data to prove that Powell is right. And the problem there is the data isn't about to turn. I mean, no one's expecting a sudden decline. That's the issue.
Dominic, wonderful to get a different perspective on things. Thank you. Dominic Constam there of Mizuho. The story, the long end, of course, is that we haven't got that stability, Tom. A 30-year up another 4 basis points to 316.
Well, the yields are moving. There's no question about it. What Dominic Constam said there, and John, this goes back to his heritage out of Oxford. He's always been pushing against consensus. He doesn't push. He crushes their consensus in the traditional economic framework that's out there. He looks at it as much more a financial framework away from rates expressing economics, much more over to a global system, and he expresses that through foreign exchange. That's what I would be watching, John, is what the litmus paper of the system says.
As for the data, Lisa, 380 on payrolls. CPI next week, 8.1%, the estimate.
And perhaps the tea leaves will be how much wages have gone up in this labor market report.
The yield's up again today, up 4 basis points on a 10-year to just about 3.1%, 3.0749. This is Bloomberg.
Of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama. Udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame. Sekarang ya ada, 1-2 itu ada. Tapi nggak kayak dulu. Kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu. 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 tuh nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu, sama aja. Belum ada turis ke Bali, masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question. Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
These are 3 central banks, all with slightly different challenges.
Right now, we're going through a hangover in world capital markets.
The fundamentals is that liquidity is continuing to drain.
They need to move on inflation. They need to move on rates.
I think we're going to stay on the edge of our seats until we see that core inflation move down below 3%.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Payrolls 90 minutes away from New York City this morning. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Futures negative, about a third on the S&P. Some real damage done yesterday, TK, across the board.
Huge damage and continuing. It's really nuanced. In the last hour, John, the FX model improved a little bit. Dollar weakness, Swiss franc as a haven scare came in a little bit. So there's some nuances there, but I would look at the equity market, John. VIX 32.84 out 1.68 points. And John, I'm sorry, there's no bid in the equity market right now.
You've got to lift the lid on the index too and look at the carnage beneath the surface.
Yeah, I
Tom.
agree. Yes.
Bank of America pointing out about half of the NASDAQ is more than 50% below 52-week highs. That's a big issue.
Yeah, well, absolutely. I mean, that's always true. Okay, first of all, there is leadership in a bear market or in a down market. We're not going to editorialize here. We would never do that. But, John, there's always that case of the getting hammered. What's interesting to me, Keefe Bruyette Index, the KBW Index, the symbol's confusing, BKX, is down 20%. And, John, I was surprised. J.P. Morgan is down a little more than the Keefe Bruyette Index. That surprised me.
Well, I wish you'd listened to me, Tom, because I've been talking about it for weeks, Bramo, haven't I?
I
go
turn
through the
you
banks
on.
day
I just
by
listen
day.
to Bramo.
You tune me out all the time. Lisa, JP Morgan, year to date, down about 22%. Goldman down 18. Citigroup down 15. Bank of America down 15.6. It's been tough, even with higher yields.
Didn't you see that story yesterday on the Bloomberg terminal talking about Wall Street bankers seeing perhaps a 40% decline in their bonuses because of the decline in the banking activity? There aren't deals that are getting done in the same extent as previous years because of the uncertainty and, frankly, the cost of financing. When you have average yields on junk bonds of in excess of 7%, that is a different landscape to take on a speculative acquisition.
Lisa, someone messaged me a little bit earlier this morning and said Bramo needs to put on her running shoes and take a victory lap around the studio. Is that going to happen today?
I have my running shoes in the other room if you really want me to get them. A victory lap for what? The carnage?
Yeah,
I don't know.
in the other room as well.
The carnage, the destruction.
I don't think that that's fair. I think that, honestly, I'm not excited to see the carnage. What I think is the most interesting, frankly, is the 10-year yield climbing the most. And this makes a lot of sense to me and was my big question after the Powell conference, which is basically, if they're not front-loading more aggressively, what does that mean about how much control they have over inflation, at least the market's belief, and how high those yields can go?
Yeah, Lisa, I'm pleased you bring that up, because at the long end, Tom, I found it really, really difficult to get a read on what's going on that over the last couple of months. I think a lot of people in fixed income have struggled with it. A lot of people tried to call the top, Bank of America, Morgan Stanley, others. Your 10-year getting out to close to 3.1% now.
We've seen some huge movement, and there's any number of outcomes here, John. The weekend reading will be absolutely fascinating, John, on this. And it is about the short term, the belly of the curve, and out long term as well. It's anybody's guess, John, and I'm going to go shock. We're data dependent as we look at yields.
Can we play data dependent bingo today, Tom?
I just want to state, Lisa mentions this. It's good to hear Bramwell click in here with the 42 miles she runs every day. My running shoes, John, are in the other room as well.
I've seen it, Tom. I've seen it. You and I have both seen it. Tom and I will walk for breakfast together, and Lisa will run past us. Just not stop and wave.
Wearing running clothes, not just randomly running past them.
Never wants to join us.
You walked by us the other day in Chanel.
Futures down about 0.4%. Let's whip through the price action. The Nasdaq 100 down 0.6%. Bramo doesn't run in Chanel. Yields up 3 or 4 basis points on a 10-year, 3.030%. And the euro, I keep going back to this. ECB official after ECB official this morning, Lisa, talking up higher interest rates. Euro dollar just short of 106.
Perhaps that's what's giving some stability to a market that has been in flux but has been stagnant over the past week. And frankly, how the euro breaks is something that a lot of people are focused on. All right, today the big number is 8:30 a.m., April jobs report. We haven't even talked about it that much, but we're probably going to get an unemployment rate that is the lowest going back to the early 1960s. We have, of course, John speaking with U.S. Labor Secretary Marty Walsh at 9:45 a.m. I want to hear what he has to say about how much wages are going up, about what is needed to bring it down, about how much, frankly, unemployment rates have to go up in order to stave off some of the momentum, some of the froth that I would say a lot of people have been observing in the labor market, including Fed Chair Jay Powell. And today we get a slew of Fed speak, including Minneapolis Fed President Neil Kashkari, Atlanta Fed President Raphael Bostic, Jim Bullard of the St. Louis Fed, Mary Daly of the San Francisco Fed. How do they respond to the market's response, frankly, to Fed Chair Jay Powell? An easing in financial conditions quickly followed by a reversal and declines. And at 4:15, honestly, this might be the most interesting interview of the day to me. Bloomberg's Michael McKee speaking with former Fed Governor Randy Quarles. I know, John, you've picked up on certain things that Quarles has said in the recent past. I want to hear his comments also on basically whether Fed Chair Jay Powell not messed up, but didn't go aggressively enough, or perhaps erred in laying out a path for interest rates at a time when the risk right now is to the upside with respect to inflation and how it comes out.
He told us earlier this week that the Fed delayed getting on top of inflation because they hadn't got clarification on leadership at the Fed from the White House. Tom, on any other week, without the market carnage, the mess, without a Federal Reserve decision, this would have been talked about so much more than it has been.
Yeah.
So much more.
This is true of a lot of things, John. The news flow has, of course, been exhausting, folks, and truly extraordinary. And I do take your point, John. This would have been much more visible at other time and place.
Let's get to the bond market conversation, shall we, Tom, with Priya Misra, Head of Global Rate Strategy at TD Securities. Priya, you said something earlier the week about the Fed struggling to get through 3% because long-end real rates have started to rise, and that is tightening financial conditions. Priya, walk us through how damaging you think that's going to be and why you question the resiliency of this economy through the rest of this year.
Sure, thanks for having me. So I think what's happened in the rates market just in the last month really has been the long end moving and long end real rates moving. And that ultimately is what tightens financial conditions, and that starts to impact, I would say, interest sensitive components of the economy. Remember, we've dealt with every recession with more debt. There's a lot of leverage in the system. And I think when these long end real rates start to rise, it starts to put pressure on the consumer, on the corporate sector. I mean, I would say the consumer much more. I mean, savings can be a buffer, but at what point does the consumer sort of look extremely vulnerable because real wages are not growing, interest rates are rising, and you have the wealth channel as well working. So we're not there yet. I'm looking at 5-year real rates closer to 1%, but a lot of that move has happened. We're closer to 70 basis points. Another 10-15 basis points higher in 10-year rates, I think we get there, and that's when I think financial conditions should sort of start to impact.
Priya, I want to take your full faith and credit work with the giant Dominic Constam, who joined us 20 minutes ago. You and Constam are on the same page. There's no other way to put it. Rates will move up, and as Constam says, that will be necessary and sufficient for the markets to calm down and for flows to solve problems. At the heart, the distinction of Constam's argument is the foreigners will step in with a vengeance and put a bid to our bills, notes, and bonds, price up, yield stabilized, even yield lower. Do you agree?
So I agree long term. I struggle with the near term. There are lags, right? Monetary policy impacts the economy with a big lag. They impact financial conditions sooner, but financial conditions impact the economy with a lag too. So I think foreigners step in. I think domestic investors step in. Treasuries provide that safe haven. But when the economy starts to show signs of deceleration, I don't think we're there yet. So I think we're in for a volatile time. We also need to understand the Fed reaction function beyond neutral. I mean, if they're going to go significantly higher than neutral along with QT, I think that's when you do see that demand come in. Because then a recession, I mean, they're trying to chase an impossible goal to get inflation down to 2% and a soft landing when they don't actually have a lot of control over inflation. So I think we do need clarity from the Fed to bring those flows in. We need to start to see the economy start to slow down. I'm not sure we're there in either case over the next few months. So I think it's going to be very choppy the next few months in the broader financial conditions as well as interest rates.
Priya, why hasn't it been even choppier in the corporate debt market, given some of these concerns that are affecting both the benchmark rate, setting them much, much higher, and also growth concerns becoming more central?
Right. I think right now the corporate bond market has just started to price this in because, the move over the first quarter was really the front end. Long end rates were relatively stable. Now, when real rates start to rise and as supply picks up, I think one of the reasons corporate bonds have been resilient is there hasn't been a lot of supply. Wait for supply to pick up and those new issue concessions reprice the entire secondary market. And I think that is something the Fed will be looking at because that's how financial conditions impact the economy is when credit becomes tight. So I'm actually really nervous about the corporate bond market. I think the equity market's done some work. Corporate bonds might be the next one as supply starts to pick up.
Priya, awesome to get your view. You know that. Great to catch up with you twice this week as well. Priya Misra of TD Securities. Just wonderful. You want to do it 3 times, Tom?
Well, I'd put her on the real yield this afternoon. I mean, you've got your properties to fill.
I've got to look at the lineup. I'm sure we've always got space for Priya. I'm just not sure Priya's got time for us sometimes, Tom.
John, can I notice some of the inflation that's out there? Maybe this is the Yanks. This is nat gas. Just moments ago to 3 decimal points, touching $9 per unit. I just say unit, folks, because I never understand BTUs or thermal units. It's a very British thing. Anyways, Paul Sankey yesterday with a shocking statement when the Chinese come off lockdown. John, $2 August of 2020, $9 essentially moments ago, and he models out $20 out there somewhere. Stunning.
Lisa, it's been a big week too.
Yeah, honestly, U.S. natural gas is headed for the biggest weekly gain, just to put it in perspective, since 2020. It just really speaks to this angst that has not faded yet.
Futures right now down 0.5% as the carnage faded. Right now we're down 0.7% on the Nasdaq 100. I think we can call yesterday carnage, Tom, relative to the monster game we got on Wednesday with the Nasdaq down about 5%.
I think it's very angst-ridden. It reminded me yesterday I went in and did crystals and pyramids and the pendulum of angst.
They will be data dependent. They will be.
Look at the Dow.
Just look at the data. 8:30 Eastern. Payrolls 380K from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. There's concern that today's U.S. jobs report will show that the Federal Reserve needs to be more aggressive with rate hikes to contain inflation. The report is likely to show The unemployment rate dropping to 3.5%, whilst wages rose 5.5% over the last year. The jobs report is out at 8:30 a.m. New York time. The EU has proposed a revision to its Russian oil ban to give several countries more time to comply. Bloomberg's learned that Hungary and Slovakia would get an extra year until the end of 2024. The Czech Republic would get an exemption until June of that year. All other EU members would phase out Russian oil imports by the end of this year. China has ordered government agencies and state-run companies to get rid of other foreign-made personal computers. It's one of Beijing's most aggressive efforts yet to eradicate overseas technology. The move could result in 50 million foreign PCs being dumped. And the embattled fitness company Peloton is looking to sell a stake of about 20% as part of a turnaround push. Bloomberg's learned the company wants to find a big-name corporation or a private equity firm. Demand has cooled for high-priced bikes and treadmills since Peloton was a high flyer during the pandemic. And a group led by former Guggenheim president Todd Boehly is close to an agreement to buy English football club Chelsea, one of the most successful of the past 2 decades. The price is certain to be the highest ever paid for an English club. Russian billionaire Roman Abramovich put the team up for sale in March, just before he was sanctioned by the British government. Global News 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Everyone you meet in Port Harcourt has stories about what they call black soot, caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
thing we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
This week, April jobs are in focus.
It's a very, very good labor market for workers. The demand for labor, obviously, much stronger than the supply.
This Friday, Tom, John, Lisa, and Mike will bring you the data and analysis as the numbers cross the Bloomberg.
As long as the numbers hold up, the Fed is going to feel encouraged.
Then 75 in June is certainly not out of the question.
To me, the question is, are we fully employed?
The elephant is the war in Ukraine.
The April Jobs Report, Friday on Bloomberg Television and Radio.
Well, I think we're going to hold 110 to 150. We've wobbled below 110, as you know, on Brent, but now we're back in the range that I anticipated.
He's one of the
Russia.
best. Paul Sankey of Sankey Research, the founder and lead analyst from New York City this morning. Good morning, Tom Keene, Lisa Bramett, and Jonathan Ferro. Futures negative 0.6% on the S&P. On the Nasdaq 100, down another 0.8%. Look out below. The yield's coming up about 5 basis points, 3.0908 on a 10-year. Just to get you ready for the day ahead, 380K is the payrolls estimate in our survey. The number comes out in about an hour and 12 minutes from now. Then it's on to next week, May 11th. The estimate so far, very few estimates coming in, but at the moment, the estimate at least, stripping out food, stripping out energy. I know useless for a lot of you at home, but that's just what central bankers do sometimes. 6.1% down from 6.5. Just where the estimates stand, Tom. Moving target, but slowly coming together.
Now, moving targets are coming together, and of course, that staggers forward to what ECB will do off Bank of England yesterday. This is a jobs day. It's an important jobs day, but the news flow, absolutely extraordinary. In the last hour, we spoke to our Emily Wilkins about the sensitivities in Washington of U.S. intelligence and the sinking, I should say, of that very large and important Russian ship. Maria Tadeo is in Salzburg, Austria this morning. My first read of the weekend, Maria Tadeo, is the wonderful Kimberly Martin of Barnard and the Harriman Institute on her expertise, which is the 800-mile border of Finland with Russia. Finland has a navy. Is their Navy at risk because of these reports out of NBC News brought on by the New York Times and the Washington Post of U.S. intelligence in the sinking of Russian assets?
Well, Tom, what we know is that Finland will apply for NATO membership. I mean, this is not official, but as you know, I was in Helsinki about 3 weeks ago, and to me, it was crystal clear. Every MP that I spoke to behind the scenes told me we are going to apply to NATO, and that could happen by mid-May, so in just a few days' time. This is a complete change to the foreign policy that Finland's had for, well, 60 years with the Russians, in which they always pledged to be neutral. And of course, they've always said that that was the best way to guarantee the safety of the country and that big border. Remember, the Russian invasion that happened in the Second World War, it was through that point. I think, having said that, they will worry about this because they feel on the interim, they're not protected by NATO. We know what happens when you're not protected by NATO. You look at Ukraine and the situation there. So for the Finnish, the next 3 weeks will be very, very delicate. And they're already, by the way, warning about this, saying we need help from our European allies if something were to happen. It's a very difficult, tricky 3 weeks before this membership is applied and hopefully accepted by the rest of NATO countries.
Maria, with all of your work, and I mean hard work and travel here, do you assume, Maria Tadeo, that all of these different countries greet U.S. intelligence? They all want the U.S. intelligence?
Oh, that they want it, they definitely do, Tom. And I would also say, and I was, by the way, just debating this with a number of officials off the record here about 15 minutes ago, and they still said, or told me, and I thought this was quite remarkable, that the U.S. had proven to be the policeman of the world. Once again, remember, we talked about in Europe this decline of American diplomacy, the decline of the U.S. Leading big foreign affairs. Well, today I had from a number of officials telling me, well, the intelligence was on point, it was perfect, they got it right. The timing, they got it right. And when you speak to Ukrainians, they also say it's not just the weapons. This intel that the U.S. shares with us has allowed Ukraine to stay very competitive in this war, where in principle, the Ukrainians should have lost weeks ago. This was an army that was almost outnumbered 10 to 1, Tom.
Emily, this is the international scene. On the domestic scene, we're about an hour, a little bit more, toward the labor market report that's expected to come in with another strong print. How is the U.S. going to spin this at a time when there are these constraints that are actually pushing up inflation costs, and then you see that wage inflation on top of it?
I think we are going to continue to see President Joe Biden continue the message of looking at unemployment. We're expecting to see that unemployment rate tick down to 3.5%. That's certainly something that Biden and Democrats can tout as an example that they've been able to bring the U.S. economy back from where it was to a pre-pandemic level. But Lisa, you're absolutely right. I mean, a wage growth, which we're again expecting to see in this report, is not keeping up with inflation. That's going to be a major issue for Democrats come November. Certainly something that Republicans have hit Democrats on again and again and again. And to a certain extent, with the American voters, it's good that people are back in jobs, but there's a lot of concern about the costs at the grocery store, the costs at the pump. That's really something that the Biden administration is focused on trying to find ways to address. We've seen lawmakers discuss that with potential legislation that could address supply chains and other bottlenecks. But to a certain extent, this is out of the White House's hands. It's a global issue, and certainly they're looking to the Fed to see what they can do as far as bringing those interest rates down.
Emily, thank you. As always, Emily Wilkins and Maria Tadeo. Secretary Walsh coming up a little bit later on Bloomberg Television and on Bloomberg Radio. Not on the radar right now, but I think this is important. The unions representing the port workers in LA, there's a round of negotiations coming up soon, Tom, that Secretary Walsh may well be involved in. And we need to talk about the terms of those negotiations. And at what point are you leveraging the power you have as an employee or holding the economy hostage? That's a very, very difficult line to tread, I think, in the coming weeks as those negotiations continue.
The Los Angeles Times has done great work on this, John. And the fact is, these are exceptionally delicate matters, as you allude to. The macro piece for Secretary Walsh is every study of Shanghai and all their lockdown issues. Every study of freight dynamics says this problem is not going away.
The White House perspective, Lisa, coming up about an hour or so after the number drops.
And I think back to the Bank of England's decision yesterday. They want inflation in wages to some degree to offset the real cost of living, which has actually been skyrocketing, and real wages have been plunging. How does the U.S. deal with that also at a time when actually wage momentum upward is going to be a negative in terms of the longer-term outlook for inflation in the U.S.? It's a very hard needle to thread.
The central bank has struggled to speak to Main Street.
Yeah.
Governor Bailey yesterday at times, it was kind of awkward. Lisa, the Fed chairman this week, started the news conference by directly addressing the American people.
They can't seem tone deaf because people are really feeling this one. It's not some sort of esoteric, larger macroeconomic picture. You don't agree, Tom?
It's not their job. It's not their mandate. I mean, it's great that they're, sensitive and all that, but this is all new territory. The wokedom of central banks is all new territory.
Well, Tom, you've also got to go back to the era of inflation targeting, the era of central bank independence. They were meant to be not accounted for by the electorate because they were meant to make the hard decisions to keep inflation low. And ultimately, in the minds of some people, they have utterly failed, totally failed. And that's why they're back under the spotlight in a massive way.
I can feel the mail coming in already.
Yeah, I bet. Futures down 0.6 on the S&P. This is Bloomberg.
companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Two numbers pop out off the page to me this morning from the team over at Bank of America with Michael Hartnett. 49 and 77. 49% of the NASDAQ trading more than 50% below 52-week highs. The other one, 77, 77% of the index already in a bear market. That's the destruction beneath the surface of the overall index. If you just lift the lid and get in there, it's really messy. Futures right now down 0.6% on the S&P. On the NASDAQ 100 down about 0.8%. Through Thursday into the close. Yes, yesterday was ugly, but ultimately on the week coming into Friday, only down by 0.03%. It hasn't been that calm, hasn't felt that way, I know, but that's just the number, the stat coming into Friday, Tom, with futures down another 0.9% now.
And John, this is important at 7:30 in the morning. Folks, the tape hasn't adjusted yet. John, this is a fragile tape. We haven't said that enough.
And there's no bounce. We're breaking down again. In fact, again, over the last 10 minutes, Tom, down about 1% on the NASDAQ 100. That's the equity story. The bond market picture, for a lot of people, very confusing because yields just keep breaking out, and they did that again yesterday, and they're doing it again this morning by 5 basis points on a 10-year to 3.0888%. Let's just round it up, Tom, and call it 3.1. That's been a surprising thing about the last couple of months. We talked all about this aggressive Fed, started pricing up the front end for a big move, some front loading from the Federal Reserve, and the long end yields, 10s and 30s, just kept grinding higher.
John, the vanilla spread is not back to the steepness of yesterday, but we've made a lot of headway here from 3 a.m. So you're getting some curve steepening, not to be inflammatory, along with that yield move this morning of, say, 5 beeps.
I'm catching up with Mohamed Al-Erin a little bit later this morning.
Oh, you will?
Just after the open, about 9:30 Eastern time. He's picked up on this point. Others have too. We're seeing 10 basis point moves here and there without an immediate catalyst. Mohamed's worried about some of the liquidity out there. We can talk about that a little bit later this morning. That's the bond market. Here's foreign exchange. I'll just finish on sterling after a big move yesterday. Cable, 123.59. Had a little look at 122. Kit Duke saying this morning over at SocGen, the penny's finally dropped. Rates are going up. Growth is going to slow, and that's hurting the Bank of England. Does the ECB have to grapple with the same dilemma when they meet next month? That's a big topic of conversation, Tom, coming up.
What is the phrase, the penny? What'd you say, the penny?
The penny is finally dropped. You don't say that here?
No,
that's lost on you.
Original.
Is that foreign?
Yeah, it's lost in translation.
Okay. I can translate
like a British
later.
penny.
Yeah.
John, do you remember like shillings and farthings and all that Charles Dickens stuff?
A little bit before my time, Charles Dickens stuff is, Tom.
Okay, I was always lost by that.
I'm lost by it now. Why are we talking about this?
I don't know.
Okay, I've got a treat for you, Tom. On single names on some movers this morning.
Oh, please.
Drum roll. Bramo is going to run you through name by name.
I did not know this.
Watch how this works, Tom. DoorDash, sell.
I knew that you were going to do this. That's why I was
Super
laughing.
bearish.
I was already
Drafts.
laughing.
My God, Bond Girl does equities.
No, I'm not going to, listen, I'm not going to give recommendations or disrecommendations considering my bearish tilt. But this actually, I'm really happy to do this because DoorDash, this speaks frankly to Tom Keane's household and how he orders McDonald's. It is with DoorDash and then it delivers it to the Keane household. DoorDash just reported earnings and they're actually up in the pre-market more than 6% because it wasn't gas horrendous. I mean, just to put this in perspective, DoorDash's shares are down 50% year to date heading into this session because of the reopening trade and how much they've gotten beaten up. Zillow is a perfect example of the slowdown that we're seeing in the housing market. Shares down almost 14% after reporting that the look ahead really speaks to a lack of sales, a lack of actual transactions because the supply isn't there and frankly, people are getting nervous with mortgage rates at the highest level since 2009. DraftKings, everyone wants to bet on sports, and so those shares are up almost 7%.
Did you bet last night on DraftKings on the Mets coming back against the Phillies?
I know that Dan Ives is betting on a Subway Series, and that was what he was tweeting about. They're doing very well,
please.
but
He's a big
really,
Mets fan, isn't he?
Yeah, he's a big
Dan
Mets fan. Yeah, and so is Mohamed El-Arian, so I'm sure you can get his view too, John, coming up. If you take a look at what is actually winning amid all this carnage, it really is the energy sector. And I find this amazing after the gains that we've already seen of more than 50% of the likes of even Exxon, shares still up in pre-market. This is where people are hiding, $91.05. Occidental Petroleum has gotten a real boost after reporting good earnings, boosting dividends by almost twice, and getting a show of support from Warren Buffett. Marathon Oil, I find this fascinating, up 1.3% after already having a blockbuster year, although Occidental Petroleum shares up more than 100% so far year to date and still getting an extra boost.
What do you think, John? Never again?
No, I think we do this again multiple times.
Multiple times.
I don't mind the bearish tilt, and a lot of people enjoy it. I love that, Lisa.
Did you see me standing there?
It wasn't bearish.
I
Was there
think-
any
I think-
aspect of bearishness
I
to
think
this?
we alternate between Bramo and Tom doing this.
Yeah, you know.
If Bramo does
I just do,
Mondays,
John, I would
Tuesdays,
just do
Fridays,
Dow stocks. I would just
you just do Dow stocks.
and a Conocopter.
They're going to be data dependent.
Okay,
That's
so
what-
let's
that's what Tom's
move
gonna
on
say.
right now.
Be
The news
data
flow
dependent.
extraordinary. John, very importantly, we're out to two big figures on the VIX. John, I've got to say right now, equities deteriorate.
We're down 0.9% on the Nasdaq, Tom. We're not getting a bounce this morning. Bottom line.
We have been, walk softly, Lisa. We have been short here on the jobs report this morning. We're going to adjust that right now with a phenomenal sensitivity analysis by our Andrew Husby out of Bloomberg Economics, the summary of which is if the participation rate moves, things happen. Husby, if the participation rate recovers about half to the pre-pandemic high, it would only take employment growth of 350,000 per month to get to a 3.0% unemployment this year. That is a stunning piece of what-if research. Julia Coronado is expert at this with macro policy perspectives as well. Julia, what is the level of that our fully employed is?
The level in terms of number of jobs that we have left to fill?
No, how fully employed are we?
We're not quite fully employed. The participation rate, as your research suggests, is recovering. It's been recovering quite rapidly. In fact, prime age labor force participation, that recovery has been accelerating steadily since January. So 1/10, 2/10, 3/10 in March. So it looks like with a strong job market, rising wages, rising inflation, and fading fiscal support, people are coming back to the job market. And we hear that in earnings reports. Companies are actually reporting that they're having an easier time filling jobs. You also see that in the NFIB. So it doesn't quite show up in the JOLTS data, but we are hearing a lot of information and seeing it in surveys that there is some balancing of supply and demand that Chair Powell talked about. And so we'll look at the report today, but I expect another gain in labor force participation, and I expect a cooling in labor demand. We see that in the ISM surveys. People are nearing their staffing goals. And now they're more nervous about the outlook. So we should see numbers. 350 is an extremely strong number. We're at 340 for today, but I would fully expect numbers closer to the 200,000 as we move the year.
Julia, do you think that the Fed can be data dependent when Fed Chair Jay Powell basically locked in the progression of rate hikes at 50 basis points over the next 3 sessions?
I mean, I think what Chair Powell expressed was enough confidence that the job market is strong enough and labor demand is strong enough that we can get 2 more 50 basis point rate hikes before they need to sort of even consider slowing down or taking a look around. And that just speaks to just how incredibly strong the job market is. So to Tom's earlier reference to Dickens, it's the best of times and the worst of times. In the labor market, it's the best of times for workers. And so, we do see that balancing coming back into view after an extreme imbalance last year.
I'm stunned by the Charles Dickens comment there. I
was ready for you, Tom.
The difference
I came for you, Tom.
Yeah, you really nailed it. The pain of parting is nothing to the joy of meeting again. Okay, we can continue now. Julia, we've got a small issue at the Hoover Institution today. Our Michael McKee will speak with Mr. Quarles about the Fed, and what's got to come up is the Fed actions of the last 90 days of last year, where maybe they didn't act because they were trying to figure out the nomination policy, process, I should say. Does this have traction?
I'm very disappointed in former Vice Chair Quarles in sort of suggesting this kind of dynamic. I think he's just doing a disservice to the institution. So I don't really want to dignify that. I think I have a lot of faith that Chair Powell acts does his level best to act in the best interest of the medium-term stability of the economy. So I'm not going to go and do Monday morning quarterbacking of what they did last year. I think there were reasons that they were expecting inflation to moderate. We've gotten hit by shock after shock, and now they're moving quickly. You got to give them credit for pivoting as quickly as they have. And they can pivot again if the data demand it. So I think this is a data-dependent Fed. I think they're trying to look through the noise, and there has been extreme noise. This has been one of the most incredible shocks the economy has ever experienced. We've seen the biggest change in what consumers buy since World War II. So I think, we've got to give the economy some time to get its legs underneath it and adjust to this composition. And meanwhile, the Fed is trying to look through all of those adjustments and figure out what the medium term looks like. So I really don't want to go there, actually.
Well, you did go there in a way, Julia, because you said it didn't matter. And I think it does. And I'll tell you why I think it does and why we should spend more time on it. Essentially, a former Fed official is questioning the credibility, the timing of this pivot. That has implications for whether this is a credible pivot or not, or whether this is just driven by Chairman Powell, who was looking for a second term. That's one Fed official saying that. Why is the voice of the former governor, Quarles, not a credible one?
We've seen this a lot before. When Kevin Warsh left the Fed, he also had some nasty things to say as he was kind of positioning for his post-Fed career. So, again, what good is it going to do us to examine this? I think if you look at, say, the value of the dollar and the yield curve, you've got some votes of confidence from the market that, it's going to be a volatile time, but the Fed is going to manage us to price stability in some way, shape, or form. Might take more pain or less pain, but they're going to get us there. And I think that's ultimately what we have the Fed there to do, is to do the hard work. So far it's not always pretty. And you can certainly, do this political second guessing, but I think the people that are in those seats right now are people that are trying to do the right thing and trying to do their job.
Julia, we appreciate your perspective, as always. Julia Coronado there of Macro Policy Perspectives on this Payrolls Friday. Good morning to you all. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. The United Nations says global food prices continue to hover near an all-time high. The crop trade has been disrupted by the war in Ukraine. The country has been one of the world's largest shippers of wheat and vegetable oil. High fertilizer prices and drought have added to the problem. The US is warning Russian billionaires there is no hiding place for their yachts. That came as authorities seized a $325 million super yacht the US claims is owned by Russian billionaire Salomon Karimov. He's accused of money laundering and conspiracy. The US worked with officials in Fiji to seize the vessel. In the UK, Prime Minister Boris Johnson's Conservatives lost seats across England in local elections, and they lost control in 3 London strongholds. But Johnson appears to have avoided the sort of disaster that might have triggered another attempt by members of his party to replace him. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ruchika Gupta. This is Bloomberg.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
The Indian city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its 2 biggest billionaires.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
In crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
U.S. being this strongest house in the neighborhood is leading to a lot of dollar strength, which is only tightening U.S. financial conditions further. So it's not just the U.S. economy is facing a more hawkish Fed, it's also facing a much stronger dollar, and those Fed interest rate increases in dollar strength are both doubling up on slowing the economy down.
Andrew Sheets, the Chief Cross-Asset Strategist over at Morgan Stanley. From New York, good morning. Payrolls, 8:30 Eastern Time, 42 minutes away. 380K is the median estimate. Right now, futures negative 0.5% after an ugly close yesterday on the NASDAQ, down almost 5%.
Yeah.
The NASDAQ 100 futures negative 0.7%. Sterling weaker again. We had a little look at 122 earlier, 123.40 off the back of the biggest one-day move lower on cable going back to 2020, Tom. Pretty ugly out there.
News flow just extraordinary. John, I was out doing my 1,000 steps yesterday. And,
just 1,000, Tom.
Yeah, some people came up to me and, the news flow, John, I mean, folks, we got a jobs report coming up in 40 minutes. You know what, John? I'm sorry, it's important.
You know it's 10x what you're doing, Tom. It's meant to be 10,000 steps. Just so you know.
Really? I didn't know that.
You've got to get that up. It can't just be the 1,000 steps,
1,000 steps
with a cigar on the phone to me in the afternoon. I know. I can hear you puffing away when we speak. But yes, you've got to sort of, let's jack that up next
Saving
week.
us right now, Kriti Gupta on volatility. Kriti, what do you have?
I'm happy to come to the rescue. Well, you heard about the ugly close that John just mentioned earlier. I want to put that into the context of volatility, but not just volatility of the equity market, volatility of the VIX index. So vol of vol, if you will, and that really brings me to my chart of the day. When you see an ugly close like that, you would expect that the volatility kind of swings up and down, but instead we've seen a very muted volatility picture. And the reason for that is who was actually behind the selling. Yesterday's sell-off driven more by ETF rebalancing than institutional sellers actively hopping out of their tech bid, for example. So instead, they're using options. Now, Tom, I asked several of my sources, what is going on? Why are you starting to see the sell-off? Pharaoh's not my source, although I wish he was. I got several sources on trading desks, and basically what they're saying is 42.70 was the line in the sand. Now they're barreling towards 4,000, and that's really where you could see a lot of these moves. This move yesterday, though, it was ETF driven.
Kriti Gupta, thank you so much. Greatly appreciated. Publishing moments ago, George Saravelis at Deutsche Bank on the same page with the guy who's been leading the charge on pound sterling. It's great to talk about these wonderful analysts and their collegiality as they agree to disagree. Saravelis, we share Jordan Rochester's pessimism on the UK, but not the Eurozone, the huge gap between global consumer confidence and business confidence. The gap is massive and has never been bigger, a key driver of markets in coming months. Joining us, always handsome from Nomura, Jordan Rochester. Jordan, 123, 122 handle this morning. Reaffirm your call on weak sterling.
Indeed, Tom, we're looking for 122.50 in the very short term. Look, when I made that, we were trading around 125. We are probably going to be heading towards 120 at the rate cable's going. There's not really much stopping it from falling. The Bank of England hiking yesterday, the pound lower after the fact. I think essentially the real yields are weighing on the UK. So no matter what the Bank of England does, if they don't entertain properly 50 basis point rate hikes, we've got some members voting for it, of course, but if they don't follow through with that, the front end pricing for the Bank of England will be disappointing. Over 30 basis points priced in for the next meeting. So as a result of all of that, it's why we're happy to be short the pound here, long the dollar. As of the two central banks, the Bank of England's much more worried about the situation when it comes to global growth slowing down than the Federal Reserve right now.
Jordan, what does positioning look like on some of those trades?
The easier one is euro. It's much more, so for example, you just put up Deutsche Bank's view on pound. It's been very easy for people to be pessimistic on sterling. Brexit's one of those factors. So the positioning in sterling is net short. So I am concerned from a speculative positioning story there for that trade. But the balance of payments for the UK is such a mess. I still think that sterling has lower. The euro, John, very, very different. So actually the market's just very slightly net long the euro. Now, if you look at leverage funds, they are net short, but not in a big way. If you look at real money, so that's your insurance funds, your pension funds, they are net long the euro, and they've been wearing that trade all the way from 109 to where we are today. So they're feeling the losses there. They are throwing in the towel on those trades, but they are yet to get rid of them. They are still net long the euro. That's why I'm happy to be short the euro from a positioning point, but also many other reasons too.
So, Jordan, do you see parity as the breaking point?
Breaking for who? The
For
ECB?
euro.
Things
Yeah,
have
for
got
euro
this
versus
nice.
Let's hope cable doesn't get down to parity.
Yeah, exactly.
I
I'm
mean,
not talking about
real
cable.
trouble, Bramo.
No, I'm talking about the euro versus the dollar.
Indeed. So, look, things have been getting a bit more spicy with the ECB this morning. We've had several ECB speakers coming out, some suggesting even the idea of a rate hike in June is possible. I think that's a bit too spicy. On the sort of curry chart, that's the Vindaloo. If we were to think more realistically, it's probably going to be July rate hike, given the few comments we've had. We've had Ollie Rehn coming out, we've had Villawar saying July is possible. So, look, it's more like the jail phrase if we're going to keep it on this curve.
Here we go. Here we go. Tom, you've got Vindaloo at the top, Korma at the bottom. All right? Just in terms of spiciness. Jordan, thank you. Jordan Rochester there.
John, would you guys are nuts. Would you translate for we mere mortals in the colonies?
Okay. All right. When you've had a long night, you go and get, say, some Indian food, Tom, and a really, really spicy dish is a Vindaloo. It's a curry. That's a very spicy dish. And if you don't like too much spice, you like a bit of coconut, maybe, you get a korma. All right?
Or chana shag.
There you go. Are we done? Futures, negative 0.5% on the S&P.
I'm just going to get the #2 value meal and a cup of coffee.
That's not what you do in the UK, Tom. It's not what you do.
Okay, I go to Dunkin' Donuts and get a cup of coffee and some donut nuggets. You know, the little
Maybe you want a fuller meal.
You can walk an extra 1,000 steps to the Indian restaurant.
Just to wind things down.
I could do that. I mean, what Rochester was out of control there, John.
You're out of control too. We're done.
I love what he said about his wearing a trade.
Well, yeah, I mean, look, there's a lot of people that were still long the euro. We had a lot of people come on the show and talk about a move back to 120.
Yes, we
They
did.
said rates are getting back to zero, et cetera, et cetera, et cetera. But what we've experienced in the UK, is yes, rates go up, but growth expectations come lower, and the currency's been hammered.
I don't know what to do with Cindy Lou Who, but I'll tell you this, John. I can tell you I'm wearing a triple leveraged all cash trade.
You can't take you anywhere. You really can't.
You don't know who Cindy Lou Who is, do you?
I've got no idea. Who are you talking about?
Folks, this is what makes this marriage go. It's like Ted Lasso, folks. About a third of the time, when he doesn't have a beverage of his choice in him, I have no clue what Pharaoh's saying.
10 generations removed.
Generations, plural. That's right.
Generations removed.
Yeah, that Austrian bond I looked at today, it's working out.
I went over that with you this morning on the Bloomberg.
working
Hey,
out.
Tom, that is ugly. That Austrian century bond, that's brutal.
Wait, can I just put on the record, you guys went to bond yields when you realized that all is lost. And I think that's wonderful. I think you should.
We spent 5 minutes together looking at the performance of the century bond this morning. That's what we did together.
Can I get some more Tang with some of that?
You've had enough Tang.
Can I get some Tang and
You've
order
had
me?
more than enough Tang.
Can I get DoorDash the Cindy Lou Who?
You need
I need
to
the Cindy
have a
Lou
lie
Who.
down and get the blankie and have a rest. All right.
Blankie.
About 1%.
It's jobs day.
1% on the S&P. You wouldn't have guessed, Tom. On the Nasdaq, we're down about 0.6%. 8:30 Eastern Time. 35 minutes away. Got a payrolls report, and your median estimate is 380k. This is Bloomberg.
nuestro estudio, nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes, según las modificaciones nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
We're still in the school zone in terms of rate hikes. We are not on the open highway.
You've also already priced in a 1994 style hiking cycle in the U.S. So I think it's fair to say that soft landings are difficult.
It's absolutely fundamental to the Fed to get a slower labor market.
Inflation is the #1 risk for markets.
It's very hard to say that inflation is just going to recede.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Jobs Day in America on radio and television. It's also markets, markets, markets. John, we got to go to the markets, even with jobs 30 minutes away. And there's just simple, John, the bid is not there.
And yesterday, absolute mayhem. A lot of people got comfortable, didn't they, after the Federal Reserve meeting on Wednesday with a big move higher in equity, started talking about a longer-term narrative. Things were changing. Maybe this was an inflection point. Then the market punished that view pretty quickly. Those 2 days absolutely whipsawed, Tom, in this equity market. In 29 minutes, we get a payrolls report. The median estimate is 380K. I'm interested in two things. One, what's the data? But two, more importantly, how do we respond to this incoming information, Tom, given the market pricing at the moment?
And what's so important here, John, is the character of this pullback that we've seen. The idea that it's been short and sharp, that has changed this latest correction pullback. And indeed, as you mentioned, John, earlier, some huge bear markets in sectors and individual securities. This is now different than short and sharp.
Destruction is the word I would use.
Yeah,
it's
I
important
like
to
that.
lift the lid on the index and just go through those numbers that BofA put out this morning. Here's one of them. 77% of the index of the NASDAQ is already in a bear market, Tom. It's already there. 49%, roughly half of the index, is more than 50% lower from their 52-week highs. That, Tom, is a big deal. We've already had a massive correction in some big names in that index.
And Lisa, the chart of the morning, George Saravelis at Deutsche Bank showing the difference in business confidence, good, consumer confidence not, and you wonder how that folds into the future of the American labor economy.
When do we start seeing a slowing in what a lot of people call overheated in terms of labor market? From an investment standpoint, though, I love how James Athey put it from Aberdeen, basically saying hope is not a strategy. And it seems like right now this idea, this sort of hope for some sort of end to the inflation isn't there. And the fact that the Fed didn't come in and stop that definitely created a lot of jitters, I think, particularly on the long end.
Lisa, I haven't looked at this. You've looked at the carnage yesterday across full faith and credit, and also high yield. Where's the hope of Athey in the bond market?
You know, there hasn't been a huge reaction in the bond market, in the credit market. There has been in the treasury market. And this is what Priya Misra was saying. When this shoe drops, the Fed notices. Until that, and somehow the resilience of the credit markets has allowed stocks to do the heavy lifting and actually go further, because the Fed is not going to come in and give a put to stocks. They will perhaps respond to credit.
John, important question. What is the key distinction between Priya Misra and Dominic Constant and others and the crew out there looking for some real damage to price down, yield up?
It's this simple. Answer the question, how resilient is this economy in the face of higher interest rates? Priya Misra doesn't think it's that resilient. Along with Dominic Constant, they think they've already seen a significant tightening of financial conditions sufficient to hurt this economy, sufficient for this Fed to back away. For this Fed, though, as Dominic pointed out, they just haven't seen the data yet. For others, they believe that if you really want to get inflation down, you need to get interest rates much higher. And others, I'm talking about not just the South Side. Vice Chair Clarida, the former Vice Chair, has basically come out this week and said it. The expeditious move back to neutral is not going to get it done. He thinks we need to get back to at least 3.5% on Fed funds.
The hawks, maybe not Clarida, but many of the Fed hawks gather at the Hoover Institution. Our Michael McKee is there with our Richard Martin, and it'll be interesting to see Mike McKee with us later with Mr. Quarles on Bloomberg. John, we could take the next 26 minutes and just do a data check. We're not going to do that. The guests are too important. We got to start with an update, John, on pound sterling.
Sterling has been pretty difficult. It had a look at 122 a little bit earlier. It's back to 123. Equities at the moment down about 0.4% on the S&P. On the Nasdaq, we recovered just a little bit, just a bit. We're down a half of 1%. I say a little bit because we were down about 1 full percentage point 30 minutes ago. Yields are higher again by 5 basis points to 3.0. Let's call it 9%, 3.09. And euro dollar just showing some strength here at 105.66. Had a couple of ECB officials out this morning talking up higher interest rates. But again, this is where it gets tough. Tell me what the central bank will do, and then tell me what the market will do in response to that. Because over at the Bank of England, we've had the rate hikes. But it's meant sterling negative. Is it euro positive or euro negative if that ECB hikes rates, Tom, through this summer?
Important note of this morning, below the radar, Peter Bookfire out with a smart note on dollar yen 130.45 and JGB dynamics, which will be interesting into the Japanese Monday that we will see. Right now, Nadia Lovell joins us, senior U.S. equity strategist at UBS. What changed for UBS yesterday, Nadia?
Not much has changed for us. I mean, we sort of came into the market expecting value to be better positioned over growth. I think what you saw selling with poor market depth, but we did see some selling from risk priority and risk controls funds. But the retail buyer did step in yesterday and bought individual stocks, and more so than they did ETF. And that's a good sign. You know, corporate buybacks, we're looking for that to pick up in the next week or so as we pass the earnings season. I think the message out of the Bank of England yesterday and an inflation outlook taken up significantly does suggest some stagflation and recessionary risk, and that spooked the market yesterday. But, you know, liquidity remains grim, and you could see some exacerbated movement in either direction. As you noted earlier in the show, VIX is above 30, and the market is really sensitive to headline risk. So we'll be watching very closely over the next week the slew of Fed speakers and CPI, of course, which is likely to impact market.
Looking ahead to Jim Bullard a little bit later. Lisa flagged that one later this evening. Nadia, I'd love to get some insight on what the conversations with your clients sound like right now. What do they sound like?
I think clients are, of course, concerned about the volatility in the market, but what we try to do is anchor our clients to longer term themes and taking the opportunity to really upgrade their portfolio in quality in this market volatility, because you are seeing a lot of quality stocks also get thrown out in this volatile market. And so we are particularly focused on some of the new themes in a new era of security, just given the ongoing war in the Ukraine that we think is changing the face of security. So we're looking at having conversations with clients around cybersecurity, around energy security, food security. We continue to see food prices move higher, and also within energy equities.
How reluctant are clients, Nadia, to go into the fossil fuels based on some of the ESG mandates that has left so many investors underinvested? It's one of the reasons why people think that there is more upside for oil companies and why they're still underpriced for the reality of where oil prices are.
I think it's a mixed bag on the ESG front. I think that clients are also coming to realization that it's going to take longer for that energy transition. And so it's having both exposure to some of the green tech and the renewable energies that are going to eventually benefit from this transition. But you can't necessarily throw out all of the oil companies. They're also making some inroads on the ESG front. And when you look at where oil prices are going, we think that Brent is going to be sustainable in that $115 range, particularly when you're seeing sanctions on Russia, both on the policy side and the self-imposed side. And you also saw yesterday, headlines around the U.S. government looking to rebuild and refill the Strategic Petroleum Reserve. So we think that the energy equities are continue to remain very attractive at these levels, and they're not pricing in that oil price in $115 and more in like the mid $70 range.
Nadia, you still have a call for the S&P to end the year at 4,700 from 4146 right now. What's going to drive that? What's going to be the trigger that moves people to buy the dip and then some?
I think you have to see the inflation data abate. I mean, we do expect inflation to start to moderate more meaningfully in the back half of the year. Like next week, the inflation print, we think, is going to remain elevated in near term. We have passed the peak in inflation. We're looking for 8.25% for next week, and then we're looking for a trend towards 4.5% by the end of the year. I think that once you start to see that will allow the Fed to not be as aggressive. Fed has already telegraphed 50 basis points for the next couple of meetings. We are in agreement with that, and we think that we'll return to 25 basis points cadence after that for Fed funds rates in the 2.5 to 2.75 range. So I think that if the Fed can navigate this very narrow path and get us to a softish landing, and there's evidence of that, I think that you can start to see equity markets move higher, and there won't be questions around the earnings growth for 2022 and 2023.
Nadia, thank you. Staying constructive, difficult time for it. Nadia Lovell there of UBS Wealth Management. In about 20 minutes' time, the payrolls report, Lisa. The estimate, 380K. The range, how many times have we done this over the last 2 years? Just how wide this range is. 517 is the high estimate. 250 is the low. Just to give you a flavour of some of the names out there. JP Morgan, Mike Feroli, 475. Goldman, Jan Hatzius and the team down at 300K. We caught it with Andrew Hollenhorst of Citi earlier. I think this is the interesting call, Lisa. He's at 360, but he's expecting, and he's setting his clients up to expect, a deceleration in payrolls growth, not because of demand, but just because they can't find the supply to meet it.
Well, and that's why perhaps the more interesting number won't be the headline number, but it will be the wage inflation number. And Andrew Hollenhorst was saying that if you see a continued acceleration in that number, then you start entering the danger zone for hard landing. At what point does the headline number not matter anymore?
Are we there? You're suggesting we might be.
I mean, I think that a lot of people are saying if it's a weak number, that might mean more about the supply than than frankly the demand. And on the high number, it's going to lead to the same kind of questions.
John, we're supposed to be in London in like 25 days. Let's go to the action now. We've been doing team surveillance, has been doing some research while we're here on Jobs Day, and this is on Cindy Lou Who, Vindaloo. And John, you got to help me. The British Indian version of Vindaloo calls for the meat to be marinated, vinegar, sugar, ginger, spices, then more spices, then spices are added. The British variation, British Bangladeshi restaurants in the 1970s. John, help.
I'll take you to Jamavar in Mayfair when we're together in London.
I'm going to Harrow.
That's a little bit more you. That's a little bit more you.
Yeah, okay.
Okay. Futures, negative a third on the S&P. The payrolls report, 19 minutes away.
Keeping you up to date with news from around the world with the First Word, I'm Ritika Gupta. We're less than 20 minutes away from the U.S. jobs report for April, and there's concern that it will show that the Federal Reserve needs to be more aggressive with rate hikes to contain inflation. The report is likely to show the unemployment rate dropping to 3.5%, whilst wages rose 5.5% over the last year. The EU has proposed a revision to its Russian oil ban to give several countries more time to comply. Bloomberg's learned that Hungary and Slovakia would get an extra year until the end of 2024. The Czech Republic would get an exemption until June of that year. All other EU members would phase out Russian oil imports by the end of this year. And in the UK, Prime Minister Boris Johnson's Conservatives lost seats across England in local elections, and they lost control in 3 London strongholds. But Johnson appears to have avoided the sort of disaster that might have triggered another attempt by members of his party to replace him. And China has ordered government agencies and state-run companies to get rid of their foreign-made personal computers. It's one of Beijing's most aggressive efforts yet to eradicate overseas technology. The move could result in 50 million foreign PCs being dumped. And shares of Under Armour are falling. The athletic wear maker's forecast showed it's struggling with supply chain issues. The company's also being hurt by pandemic-related shutdown in China. Sales there were down some 14% in the quarter. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This week, April jobs are in focus.
It's a very, very good labor market for workers. The demand for labor, obviously, much stronger than the supply.
This Friday, Tom, John, Lisa, and Mike will bring you the data and analysis as the numbers cross the Bloomberg.
As long as the numbers hold up, the Fed is going to feel encouraged.
Then 75 in June is certainly not out of the question.
To me, the question is, are we fully employed?
The elephant is the war in Ukraine.
The April Jobs Report, Friday on Bloomberg Television and Radio.
Employment is strong, consumer activity is strong, consumer balance sheets are strong. So it's not a situation that calls for an emergency type of move, and I think he very clearly took 75 basis points off the table.
Dennis Lockhart, the former Atlanta Fed president there. From New York, we are 12 minutes away from the payrolls report in the United States of America, and here's the price action going into it. In the equity market on the S&P, down 1/3 of 1%. Off session lows on the NASDAQ 100. Futures there, negative 0.5 of 1%. Yields higher going into this one by 4 basis points at 3.08%. In the FX market, euro showing just a little bit of strength after showing a lot of weakness yesterday. Euro dollar 105.68. Positive there, 0.25 of 1%. Just rattle through some of the estimates out there, Tom. 380K is the payrolls estimate in our survey. Unemployment 3.5, down from 3.6.
Beneath the headline data, some huge dynamics here of the state of the labor economy this far along in a wonderful recovery from a pandemic. To our jobs report here in 11 minutes, the professor from the University of Chicago Booth School, the former governor of the Federal Reserve System, Randall Krosner, joins us this morning. Randy, I want to go Greenspan on you. Chairman Greenspan really cared about confidence. George Saravelos at Deutsche Bank points out that business confidence and consumer confidence have never been farther apart. How do you believe that dynamic will work? Will business confidence move gloomy as the consumer does?
I think that's right, because I think there's so many shocks. Just put all the issues with the Fed aside, that the Fed's going to be raising rates quite significantly. There's so many shocks that are out there, whether it's on the supply side, sanctions, war, and the continuing uncertainty about that. I think that naturally would lead the economy to be slowing down. Plus, the Fed's got to be moving to raise rates fairly significantly to try to rein in inflation. That's a pretty tough 1-2 punch.
Randy, how do you think we should interpret this data this morning, 10 minutes away, payrolls? Trying to understand what's important in this, what will matter ultimately to this Fed rate path, which for the summer at least, they seem to have taken everything off the table and just said 50, then 50 again, and August reassess. What are you looking for?
So I think that's likely to be right. I don't think the jobs report is going to be enough to move them off from that. The labor market is still extremely strong, but I think it's going to start to weaken. And so this is why the Fed needs to act sooner rather than later, because they've got a small window. With the unemployment rate below 4%, they're going to be able to continue to raise rates without getting too much political pressure. Once the unemployment rate gets to 4 or 5%, it's going to be much more difficult for them to move. That's why they've got to move those 50 basis points each meeting.
Would you have liked to see 75 basis points on the table?
I think we'll have to see how inflation evolves. Certainly, I'm not sure I would want it off the table. I think the chairman has clearly taken it off the table. But, if they move 50 basis points at the next few meetings, they'll be getting interest rates up to a reasonable level, in the 3% range.
Randy, why did you say they'll come under political pressure? Why do you think that matters for a Federal Reserve that's meant to be independent?
So, of course, central banks are supposed to be independent and the Fed is formally independent. But, of course, Congress can always change the Federal Reserve Act. Congress can always tell it to do something. Look what happened during the initial response to the pandemic. They gave resources to the Treasury to tell the Fed to do lending in certain areas. Could something like that happen again? I don't think it's inconceivable. So that's why I think the Fed needs to move quickly, both on the economy, on the economic side, because they have to make sure that inflation expectations don't get out of control, and because they have to worry about the political pressures.
So, Randy, this is really important. Are you saying an independent central bank can't do what it's meant to do because it's worried that if it does, it won't be an independent central bank? So aren't we just questioning the independence of the central bank anyway?
Well, in a democracy, the so-called independent institutions have to be accountable in some way or other. So it's not like that the central bank is something that can do whatever it wants to do and is unaccountable. It has to take into account the consequences of its actions, and has to be able to explain what it's doing, why it's doing it. And I think if it does that, and does that very clearly, then it was able to do what it needs to do. But it also has to take into account the political pressures that are going to be there.
Randy, just to follow on to what John was saying, he was talking about Quarles and former vice chair, and he was coming out and talking about how the reason why Chair Powell did not raise rates earlier was because of pressure from the political sphere, since he had not been reconfirmed. Do you think that it was a flaw? Should it have been motivated in some kind of political sense for them not to have raised earlier that will have a material effect on the economy?
Well, I think if you look around the world, everybody waited too long. It's with 2020 hindsight, nobody started much earlier. The Bank of England started a little bit earlier in December. So it's hard to say that it was just specific political pressure in the U.S. I mean, the ECB has been very slow to the table. Many other central banks have been slow.
Professor Krosner, you have established the University of Chicago Booth School in London, which means you need to be social in London to advance the mission of the Booth School. How important is it to be in Eastern Indian restaurants eating vindaloo? Is this something on the agenda for the University of Chicago Booth School in London?
It's very important. We have a very international set of students, and being able to enjoy vindaloo with the students and our great alums is one of the great pleasures of being in London.
I'm just here face planting the microphone for people who can't see as Tom asked that question. Randy, you're going to be sticking with us after the Payrolls report in a couple of minutes. I'm looking forward to your response to it. Randy Krosner there, the University of Chicago Booth School.
We haven't said enough about what they've accomplished. This has been hugely successful for Booth School. A lot of schools go down in flames on this. And with his leadership, they've nailed this.
Well, I'm pleased you brought that up in your very sort of unique way, Tom.
Well,
Payrolls, 5 minutes away. Mike McKee's going to break down the numbers for us. We'll get a reaction from Randy, and then a reaction from Jeff Rosenberg of BlackRock, who I have to say, after the Fed this week, was absolutely brilliant. Just going through the things that matter, the things that don't matter, and maybe some of the errors he thought at the time, Tom, this Fed had made.
What will wage dynamics be in this jobs report? We're making jokes about Vindaloo, John, but this is serious stuff.
I agree.
What are the wage dynamics going to be that we see in 4 minutes?
Stats of the week. Lisa talked about it. Deutsche Bank highlighted it. Citi highlighted it. 2 available jobs open for every unemployed person in this country right now.
Folks, truly, as we saw with Bank of England yesterday, this is original where we are right now. I can't say that enough.
Going into this, futures negative 0.4% on the S&P. On the Nasdaq 100 right now, down 0.6%. Yields are higher by just a couple of basis points. We trimmed some of that move just a little bit, up 2 or 3 basis points to 3.06% on a US 10-year. Foreign exchange, the euro stronger, dollar weaker, euro dollar 105.70. Crude just short of 110, 109.63, up a little more than 1%. Your payrolls report up next. The estimate 380K, the number just around the corner.
know that it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
From New York City on TV and radio, this is Bloomberg Surveillance. Your payrolls report is literally seconds away. Futures down 1/3 on the S&P. On the Nasdaq, we're down 0.5%. Yields just a little bit higher by 2 basis points to 3.05. Your estimate is 380K for the month of April. The headline number for unemployment, your estimate is 3.5%. Let's get across to Mike McKee. Mike McKee, this one just a little bit delayed.
It is, John, and I was just bragging about how the Bureau of Labor Statistics gets their numbers out quickly. We're waiting, and it may be that there's just so many people looking for this. So we're starting to get the numbers. The unemployment rate comes in at 3.6%. That is unchanged from last month. We had anticipated it would fall to 3.5%. Average hourly earnings, a little bit less than economists had forecast. 0.3% rise, which puts us at 5.5% for the annual rate, and that is down a tick from the prior month. The one number that hasn't come across yet is the total number of people who have been hired this month, and let's see if we can get that. There we go. 428,000 is the number, so better than forecast. The forecast was 380. 428 is also the prior month, so no change in the total number. And this makes the 12th straight month in which we have seen job gains of over 400,000. The change in private payrolls is 406,000, manufacturing 55. So very strong numbers for manufacturing, and that is as companies start to reopen and start to get people back into the labor force as they try to ramp up production. The revisions subtract, it looks like, 39,000. So I don't have the exact breakdown yet, but it does look like we lose 39,000 jobs from the prior month. And so at this point, the change from March down by 3,000, and the change to February down by 36,000. So labor force still in very good shape at this point, and we're still seeing a lot of jobs created. The average work week unchanged at 34.6 hours. And just looking quickly at some of the numbers in terms of the payroll employment, leisure and hospitality up 78,000, especially, I don't know if there's a category for Indian food, Tom, but so eating and drinking places up by 44,000, non-durable goods 24,000, transportation and warehousing 52,000. That's been an interesting one to follow because of the changes in the way we buy things. So all in all, it looks like at this point on first glance a pretty good report, and it sort of supports the case Jay Powell is making this week that the Fed has some room to try to raise interest rates without sending us right into recession.
Mike McKee, thank you, buddy. Looking forward to your coverage, your interviews through today. Let's get the reaction in the market off the back of some of this. Initially, as this started to bleed out, we got a clip higher, a pop higher in the equity market. Then we started to fade again. The S&P down by about 0.1%. NASDAQ futures down 0.2%. Looking at yields at the front end came in just a little bit, as I say, as some of these data points started to come out, and then it's come back again. We're up about a basis point on a 2-year to 272. That's a story for equities and bonds alike. I want to cross over to Randy Krosner now, the economics professor at the University of Chicago Booth School and former Fed governor too. Randy, I'd like your reaction to the payrolls report, one, but also two, just what happened with participation, with that participation rate coming in a lot more than it was expected.
I think the job market is numbers are basically along the lines of what people had expected and along the lines of what the Fed had expected. Jay has characterized the job market as very strong. This continues a very strong labor market, and I think you'd said that the labor force participation rate is starting to move tick up further.
Come back down rather, Randy, actually to 62.2. The number
62.
previously was 62.4. We thought it would come back to 62.5, and that's what sort of jumps off the page at me. That seems to be where the surprise is. Bit of a downside surprise on participation. What's your read on that?
So I think, that's been bouncing around a bit. It's been coming back, but still bouncing around. There's still a lot of people who are saying, hey, I'm not so sure about whether I want to be in the job market right now, both because I've got a lot of savings, so I don't necessarily need to be working, and because I'm still a little bit concerned about those variants that are spreading around. So that's going to be a continuing constraint on growth, because you're just not going to see as much labor force participation, and that's going to continue wage pressure.
Randy, thank you. Just the initial response to some of this, Tom. The headline number 428, the estimate 380K, the previous number revised, believe it or not, 428. Yeah. Wages come in a little bit lighter, earnings month on month, just a touch lighter, Tom, than expected. And participation coming in more than expected. We were looking for a rise there, we got a fall. Right. And looking at unemployment, we were looking for a drop back to 3.5%. It stayed at 3.6. No major changes here, TK. Yep. As Mike McKee pointed out, pretty solid labor market still. And I have to say, no major changes in this equity market, with the exception of maybe the NASDAQ, which about an hour ago was down 1%, and now it's basically unchanged.
Yeah, I'm looking at some of the sub-indices, and it shows that there's a little better equity character to the market, John. John, we got to stop the show here and make clear, first of all, the phenomenal job that Michael McKee does. But, John, I hate this new release of unemployment data. It's clumsy. It faked the market out here at 8:30 in 2 seconds or whatever.
I hear you.
It's just what they invented, what was it, 2-3 years ago? Terrible.
Well, we used to have a lockup, Tom, just to get the data ahead of time.
It was way better in the lockup.
And then you'd release it when it needed to be released, and a lot of that went away.
Well, I hope that Secretary, you won't bring it up with Secretary Walsh or so many other issues, but they got to fix this. I mean, the way it's released now is really, really problematic. Never problematic is to speak with Jeffrey Rosenberg with BlackRock, a tour de force on our Fed show a few days ago, and he joins us again. Jeff, to me, it's a massive continuum. It's just a movement forward of the American labor economy. Does that surprise you?
No, this is a very strong labor market. The markets are parsing the very small, deviations versus expectations, and I think Jonathan, highlighted it. The participation rate, is a little bit disappointing, as Randy kind of laid out. I think that could be chalked up to the surge that we're seeing in the Omicron BA2 variants and some of the impacts there. That's a bit disappointing. On the other side is the disappointment on the AHE figures, which on an unrounded basis, 0.31 month over month, year over year, a little bit lower than that 5.5%, 5.4. So that helps to offset. This is a little bit, kind of splitting hairs, but where we're focused on is the expectation is the healing on the supply side of labor market will help to bring the pressure down on wage inflation. And this report doesn't really clarify which way that goes. I think it's, last I looked a minute ago, kind of a mild market reaction. So the story remains the same. Very strong labor market, uncertainty as to whether or not we're going to see the pressure come off on wages by more supply on the part rate, John, as you mentioned. You can't say that this is a strong ringing endorsement of the view that the supply side is going to come and ride to the rescue of the wage inflation pressures.
Honestly, I find this report on the margins really confusing because you have a beat in the overall numbers, which would suggest more people are coming in, that the supply is greater, and yet you have a decline in participation. It's a bit confusing. At what point, Jeff, can we say that the data starts to matter in terms of giving the Fed some sort of conviction in moving either faster or faster longer or pulling back?
Well, it's that wage piece, so we're not really getting a material slowdown yet in the wages. And most importantly, as Powell said 2 days ago, 1 month isn't going to be that definitive change. It's going to be the trend in that wage inflation. And right now we're coming off of a very strong ECI print, the quarterly prints. This AHE rate isn't really materially decelerating. You could argue there's a little bit of deceleration in 1 month, but it will be that sequence of reports and lots of different reports that we track the labor market, from survey data to Atlanta Fed wage tracker to the ECI to the monthly labor reports. They all have to point to the same direction, that we're seeing the froth, the heat come off on the labor markets. That will give the Fed the confidence that what Powell said 2 days ago is correct, which many people, I think correctly may have disagreed with. Where are we with respect to the wage price spiral? His view was no need to worry. A lot of other pieces of information saying we may be right in the middle of that. And so the wage figures are really going to be center on that. Not much new that we can take away, maybe a little bit on the margin, but it's a pretty mixed report.
Another big range in this equity market. The S&P now positive 0.1%, the Nasdaq 100 up 0.2%. Already this morning, a pretty big range on Nasdaq 100 futures. At the lows, we were negative 1 percentage point. The low was a little more than an hour ago. Big turnaround, positive 0.25%. I'll be catching up with Rick Reeder, Jeff's colleague, in about 30-40 minutes from now to go through the bond market and what this all means. I'll catch up with Anastasia Amoroso a little bit later after that with Mike Collins and Mohammed Al-Erin around the opening bell. After that, TK, if you haven't had enough, we'll get the view from the White House. Secretary Walsh coming up very shortly in the next hour.
Well, the Secretary is going to look, John, at a 3 months moving average on non-farm payrolls with that big 700,000 statistic of 535,000. Jeff Rosenberg, let me ask you a really, really dumb question. The public's going to want to go, what's wrong with generating 535,000 jobs per month over 90 days? Why are people lathered up at this sterling job formation?
It's a great question, and go back to what Powell said Wednesday, what we discussed, and I think it was the most important takeaway, because what they're really trying to say is they're on the case of inflation, that inflation is the most important objective within the dual, or if you add financial stability, the 3 objectives. And what he said clearly was that you can't have the benefits of broad-based and inclusive labor markets without price stability. Price stability is necessary for the benefits of that labor market growth. So if we're generating too much job growth, we're generating too much inflation, real wages are falling. And that's really the issue we have right now, is that, yes, there's a lot of strength in the labor market, but it's not keeping pace with inflation, which means real incomes are falling. And that's why when you look at consumer confidence, when you look at small business confidence, the confidence figures are falling, and in small business are exceptionally low because of the impact of this inflation. And so they're going to preference fighting inflation over the job market. Now, what he said is, hey, they can do both. They can find the path. There's not going to be a recession. There's plenty of froth that they can take out without raising unemployment. we'll see whether or not that's going to be the case. You can see lots of former Fed officials coming out and saying that's not going to be the case, and they're going to actually have to tighten into restrictive territory. But it's because inflation is the most important priority right now.
Jeff, after yesterday, there was this whipsawing in markets. And today, we're looking at the carnage of yesterday. And some people are saying, is it time to buy the dip? And I know that you've been cautious. I'm wondering if you're more or less cautious after the price action and, frankly, the willingness that people have to just absolutely go and just take the message on inflation away from the Fed and put it towards something that is a more concerning nature.
I would say when you look back at Wednesday and Thursday, you know, what happened, right? And lots of people coming up with explanations, but just what happened was massive uncertainty reflected in huge swings in financial markets. And so the takeaway is this is a reflection of the significant point we are with respect to uncertainty around policy and the economic and financial implications of that policy tightening. And so it makes me, you know, I guess, you know, reaffirming our more cautious view that that swing in financial markets is validating that this is going to be a very tough environment until we get through the clarity around what is that path of inflation and how tight does the Fed have to get. When we're in that uncertainty period, you have to expect that's reflected in these higher levels of volatility and therefore a little bit more conservatism in your portfolio.
Bloomberg Television, Bloomberg Radio, Jeffrey Rosenberg of BlackRock, and really want to note here the improvement in the tape. Sigh of relief jobs report with grim follow-on from yesterday's carnage. We do better here. Futures -5, Dow futures -25, and the VIX was out 2 big figures and is now up only 0.71 points. You see it with dollar quiescent. Even the yen cooperates here a little bit. So there is a market adjustment this morning. I need to go to Michael McKee, who's in the most important place in economics in the world today. This is Palo Alto, Stanford University, the heritage of the giant John Taylor, Michael Boskin, and the others, and the Hoover Institution. Michael, the Hawks have assembled, some would snark and say, Hoover Institution today, a lot of Fed speakers, including Quarles, but maybe Bullard there as well. This is a jobs report that entrenches the Bullard view of let's get going, doesn't it?
Well, it certainly makes the case on both sides that the chairman and Jim Bullard have been making. We lose 363,000 people from the labor force, which is the sort of bad reason that the unemployment rate was unchanged. And construction jobs, only 2,000 added. That may be an early sign that we're sort of running out of workers, which would push wages up and be more inflationary going down the road. But you saw the average hourly earnings, and that may be a composition effect, but they came in lower than anticipated. So on the one hand, you got Jay Powell's argument that the labor market is really strong and we have a little time. And then you've got Jim Bullard's argument that we are still seeing wage pressures over 5%, and this is not going to be good in the long term, the long run for the economy.
Michael McKee early in the morning in Palo Alto. He can go to Stanford, folks, and say on the one hand this, on the other hand that. He's allowed to do that on the academic trip. His incredibly important interview this afternoon with Randall Kors, a controversy with a former vice chairman. Right now we're going to bring in we're going to bring in Ira Jersey here with dollar a little bit weaker. Ira Jersey looking at the bond market, the short-term space as well. Ira, this is a confidence-building jobs report. 400,000, 500,000 3-month moving average. This is a job formation economy. What does the yield market say about that?
Yeah, so Treasury yields are certainly in a situation where they think the economy is pretty good and the economy is going to continue to stay reasonably robust. I mean, some of the details of this data, which you've just been talking about with Mike McKee as well as Mr. Rosenberg, does show that maybe some momentum in some of these figures is maybe rolling over a little bit. The fact that you've had hours worked down a little bit, for example, is something that I think could ultimately be important. But maybe you're working less hours because you're making a lot more money than you were, right? So the bond market right now, especially with the recent steepening of the yield curve, I think shows that the market certainly thinks that you're going to have a reasonably good economy over the coming months.
Does the bond market imply, Ira, that the Fed doesn't realize the urgency with which they have to raise rates? And I say this because we have seen a steepening in the yield curve, as you've mentioned, and that long end doing a lot of work for the Fed, frankly, that the Fed's perhaps not doing right now.
Well, so the yield curve had done nothing except flatten almost all year in anticipation of a relatively hawkish Fed. So I think some of the recent steepening of the curve is just an acknowledgement that maybe the Federal Reserve's not going to go as quickly as the market was anticipating. Now, I don't think that the market's interpretation of what Chair Powell said is necessarily correct, because even though the Fed is not going to hike 75 basis points in June, that was completely squashed, that doesn't preclude them from doing multiple 50 basis point hikes in the second half of the year. And that's not being priced right now, right? So what happens if we start pricing in 50 basis points in September and November and December? Well, now all of a sudden you're going to have a significantly flatter yield curve because the market will have to adjust for that eventuality. But we might not price for that until we have a little bit more data, and maybe in June you get some more hawkish statements from some members of the Fed saying like, hey, 50 basis points is the new 25. We're just going to go 50 at every meeting until inflation is squashed.
We've been seeing a lot of volatility in rates, and it's unusual to see this amount of volatility, at least based in the past 20 years. And Ira, do you have any sense, based on positioning, of how far we are from some sort of capitulation, a washout, some stability in rates?
Yeah, I still think that our view of yield curve flattening is still more or less the consensus. So I do think that some of what you've seen is certainly an unwind of a lot of flattening trades. Liquidity in the Treasury market right now is very poor. So you have dealers that aren't necessarily willing to intermediate without having very wide bid offers and with significant with being able to lay off the risk that they would have to take. And remember, the Treasury market is significantly bigger than it was. And with the Federal Reserve now out of the market, not buying in the open market, before you had the Federal Reserve was willing to take any bonds at whatever price basically the dealer community wanted to give them, and they're not there. So liquidity's bad, and you're going to see these 10 basis point moves every day more frequently than you have in any time that the Fed was in the market.
Ira, not that it's a gossip show, but let's go there on a Friday afternoon where everybody's going to regroup into reading and thinking, including Bloomberg Intelligence this weekend. What's the carnage out there, Ira? If we go 10 beeps this way, 10 beeps that way, who sees portfolio values decrease, or is there somebody out there right now making a fortune?
Well, in the not too distant past, you were paid for selling volatility. So you would basically, people would sell, say, 3-month options on 10-year rates, and you would basically clip a coupon by selling that volatility. A lot of those people who were doing that are going to be much less likely and inclined to basically sell that volatility. It's one of the reasons why you see implied volatility in the options markets, and not only in the rates markets, which certainly have shot up and are sky high. But you had talked about the VIX before, Tom, and that over 30 right now, that's implying that, look, we're going to have a significant amount of volatility for maybe longer than most people thought. And I think the uncertainty around the Fed's policy path is certainly contributing to that outlook that volatility is going to remain high, both on a realized basis as well as implied.
I look, Ira, at the next step here. What do you write about this weekend? I mean, again, to me, folks, this report is a massive continuum of what we've seen over 60 days is where we are. What are you going to write about this weekend, Ira?
Yeah, so next week we're going to put out a pretty big report on where we see the fundamentals now that the Fed's out of the way.
Well, give us a head start. No one's watching.
So right now we're trying to determine, okay, what's the next step? Where are 10-year yields going to be now that we're solidly above 3% for the first time since 2018? Where are we going to go? Are we going to hit 326 and then go further and go beyond that? That was the 2018 yield high. Are we going to see 3.99%, which was was the June 2009 yield high on the 10-year and the highest we've seen in the last 14 years? Or are we going to, kind of hover here as was our base case prior to the Fed meeting, where we're going to stay somewhere between 275 and 3.25 until such time as the Fed basically completely squashes inflation, then maybe we rally back a little bit during the next recession.
As usual on Bloomberg Surveillance, Ira Jersey driving the price higher, the yield lower, the 10-year yield 3.09% right now. Joining us now on the equity markets, Michael Casper, working with Gina Martin Adams at Bloomberg Intelligence. The thing that your team is writing about this morning after the last 48 hours, what's the theme?
Yeah, so we were really watching that average hourly earnings number. That's a big factor in some of the discretionary weakness, some of the industrials weakness, and some of the tech weakness especially. Those companies have the highest revenue per employee, or need to gain the most revenue per employee to make ends meet. And so their margins have really been kind of under pressure, and that's the figure that we're really kind of honing in on. So what
you see here at 8:30? I mean, how do you calibrate that right now?
It was pretty much right on expectations, the average hourly earnings number. I don't think it changes the narrative very much for the market. I think those... It was pretty much right on expectations, the average hourly earnings number. I don't think it changes the narrative very much for the market. I think those stocks should have a prolonged period of weakness given the margin pressures that they're facing.
Okay, so Lisa can ask a question. He's so gloomy, Lisa. Welcome, Michael Casper.
That it matches with me. Just to give you a sense, if you're just tuning in, about what the numbers actually were. And I find this interesting. The headline number was a beat, 428,000 versus the expectation for 380,000. The unemployment rate, though, however, came in higher than people had expected, staying the same at 3.6%. And labor force participation actually went down. And this was surprising. People are expecting more people to get into the labor force, and you're not getting conviction about whether the tightening in conditions, the higher wages, are bringing more people into the labor force. It was inconclusive. And in the bond market, just to give you a sense, the 10-year yield now climbing to session highs near 3.10%, as people take a look and say, well, maybe this justifies the Fed not going fast enough in the short term, because it's not a screaming alarm bell in terms of the inflation and the acceleration. Michael, how much have we priced in to the equity market, to big tech in particular, when it comes to some of the rate increases? Have we basically priced in that the Fed is going to raise rates 3 times 50 basis points and then wait, or is the equity market more concerned than that?
Well, there's been a significant amount of pricing, certainly. I mean, obviously, we're down more than 10% on the S&P 500. But I think that looking at our fair value model can be a really good guide here. And if the 2-year gets to 3%, it's kind of hovering near there. The justified PE for the S&P 500 should be around 14 times. So there could be a little bit more to go, especially if rates continue to rise and yields continue to rise. And if the Fed keeps hiking rates, it's certainly a possibility.
But into the weekend where everybody's trying to recalibrate here, and it's cash and asset and all that, your statistic of a price earnings ratio of 14, I would say that's uncommonly low versus many other ratios we hear. How are you getting to a fair value of 14? What's the distinction there of 14 versus 16?
Well, that again requires the rate picture to move in the right direction. So you need the 2-year to get to 3%. You need the 2s, 10s spread to widen, particularly from here. You need earnings growth to come in particularly weak as a result of some of these Fed hikes. Companies are going to be struggling with that over the course of the next few years. So you need kind of all these a little bit more bearish sentiments to filter through the market.
Mike, for a lot of the pandemic era, we talked about retail traders pouring in and really bidding up a lot of the stocks that have gotten crushed over the past 6 months. How much have they exited versus trying to come in and buy? In other words, does a retail trader really matter in the same way that people said they mattered during the height of the pandemic?
Yeah, I'll put my small cap hat on right now. It seems like the retail investors are fleeing a little bit. I've been in particular watching the meme stocks, so AMC, GameStop, that kind of stuff, and they've been facing an extreme period of weakness here. And I think that's all kind of part of the retail sentiment and the retail weakness here.
Okay, well, we'll do that. We haven't covered the memes since time began. But what that speaks to is profit companies versus less profit companies. Is that the key distinction going forward?
Certainly. And in small caps, you've seen profitable companies outperform less profitable companies or
even within
not
those
unprofitable
indices.
companies. Yeah, within that indice. It's the same kind of thing with low vol. You want to be in low vol stocks. You want to be in low earnings vol stocks.
One last question here, and before you write up for Bloomberg Intelligence, the major thing Lisa and I saw this week were stunning predictions on the price of energy, of oil and nat gas. Are you people going to write this weekend about hydrocarbons?
Probably not.
Probably not. That's not the right answer. You're supposed to say yes. So we're all waiting with bated breath after the surveillance nap.
Energy is only 2% of the S&P 500.
The problem here, Lisa, is you got to understand. Casper got into Union College, and all you need to do to get into Union College is spell Schenectady. That's all you got to do.
That's an IQ test to spell Schenectady. Michael Casper, thank you so much. I got to say, honestly, Tom, you ask him, are you going to be reporting on hydrocarbons or writing it up? And he just gave an exhausted sigh, which really spoke for all of us. This has been an exhausting week, an exhausting year.
But come on, Lisa, look at what Paul Sankey said or what J.P. Morgan said about a clearing of the China lockdown. Boom, demand comes back.
And that has been a huge theme of this year. The one place where people have hidden has been in those oil stocks, but it is a small part of the index. Maybe it gets to be a much bigger one. I think it's got a bigger economic implication, frankly, when you talk about oil and gas than it does an equity implication, because that already has been an area of an incredible interest. But on a broader sense, does that take away from some of the profits and from some of the earnings on the other side? I got to say, Stuart Kaiser summed it up, this exhaustion. He said, please reach out if you'd like to vent. That was in his comment this morning as he gave a sense of what the heck happened over the past 48 hours.
There's a lot of that going on. We've back 48 hours. I was stunned looking. This is at the Dow, which I know is not indicative, but away from the carnage of the NASDAQ, tech and the rest, we're sort of like correction, but it's been the slow motion nature of it. And we're not used to that. We're used to down, pandemic, get over it, boom, stimulus, Biden saves the day, et cetera.
I think that's a wonderful point, Tom.
Did I do okay?
And you did fantastically. And you even conceded that the Dow might not be representative, which I know John will clip and will play on repeat. I do think that what you're saying is something that was reflected in a lot of notes. This has more of a 2000 or 2002 feel to it, rather than the sort of dip and then buy that we have seen over the past couple of decades.
It has been a historic week. We need to do a rave for the Bloomberg booking team. We've got a team of 42 people that work constantly to be sure we get the right voices here on radio, on television. And Lisa, to go back-to-back Fed Day and that excellence, and today, after the market turmoil, I'm sorry.
We owe our team a lot.
Let's not go overboard.
Stop. They do.
Guys, McDonald's after the show.
All the road trips.
Futures negative 26. Stay with us. The Secretary of Labor next.
This equity market is an absolute mess. We are all over the place. From New York City this morning, good morning, good morning. Equities down, equities up, equities back down. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrow.
Live from New York City, we begin with the big issue, the U.S. payrolls report and a messy, messy equity market. Joining us now is Bloomberg's Mike McKee with more. Hey, Mike.
Good morning, John. Well, the message from this payrolls report is if you like the March number, you're going to like the April number because almost nothing changed. If I had a nickel for every time they say little changed in the report, I'd be a wealthy man. 428,000 jobs restored in the month of April, exactly the same number as in March, even after revisions. The unemployment rate unchanged, 3.6%. Now, part of that is because the labor force did fall by 360,000 63,000. That is a bit of a surprise given the efforts of companies to get people back to work. The participation rate dipped a little bit during the month to 62.2. So we have a kind of a participation problem that we may be topping out. You see that a little bit in the numbers for the kinds of jobs that were created. Manufacturing, 55,000. Leisure and hospitality, 78,000. Now, those appear to be similar, but leisure and hospitality have been adding more than 100,000 a month for some months, and so this is a dip there. Transportation and warehousing, much better than retailing these days. That's where the Amazon people end up. And then construction is an interesting one. Only 2,000 jobs created. Are we beginning to run out of workers, or is it because interest rates have gone up and builders are going to be putting fewer homes in the ground because people can't afford it? These are kind of the few questions that this report raises. We did see a lower than expected average hourly earnings coming in at a 5.5%, down a tick from last month. When you put it all together, there is a sort of feeling that at this point you could make an argument either way, that Jay Powell has time or that they need to get going because we're still seeing inflationary wage pressures. It's that kind of report today. We don't have a lot of distinction.
Mike McKee, great to catch up with you, sir. Looking forward to the interviews through today. A few questions about this labour market report, a ton of questions about this market. Yields were up, then they were down, now they're higher again. On a 10-year by 7 or 8 basis points to 3.11%. That's the 10-year. Let's talk about the mess that is the NASDAQ 100. Yesterday down about 5 percentage points. At about 8:30 Eastern time, after this number came out, equities snapped higher. An hour earlier, they were down about 1%. Right now, they're down 0.9% again. The range has been huge already. The lower the session, down 1.1%, the high up a third of 1%. BlackRock's Rick Reeder joins us right now to work through some of this mess, at least. Rick, so let's start with the jobs report, then we'll get to this messy market. Your reflection on the numbers that came out 30 minutes ago.
Well, it's easier to describe the job market than the actual financial markets. I will start with, listen, I think Mike McKee described it exactly right. I mean, it's a number not terribly different from what we saw last month, and it's not going to do anything to deter where the Fed is going. I mean, it was strong enough for the Fed to keep going across every metric. Jonathan, the thing that I think that I'm watching like a hawk now is I do think what Michael was saying, some of the things are transitioning a bit. And so you can look at, one of the numbers I focus on is business services and temporary hiring. Well, temporary hiring the last couple of months has been flat. In a hot job market, you generally don't see that. So watching some of this data and, the average hourly earnings, maybe not as strong. Listen, I think we're watching them, and boy, I read a lot of earnings reports. I do think, when you hear, and as Michael said, Amazon came out and said, we're going to slow down the pace. I do think we're transitioning, not enough to a slightly less robust labor market, not enough to take the Fed off its path. But I think the next few weeks, I should say, you're going to see some companies pulling back. I think interest rates are biting. I think input costs are biting. And I think companies you see this in earnings reports, they're talking about uncertainty, hard to project forward. And I would be surprised if you didn't see some hiring start to slow down on the backside of that.
Rick, that begs the question, the trillion-dollar question then. The implications for your investment decisions, what are they?
So listen, I think the overriding principle for all investing today is financial conditions are tightening. And the Federal Reserve has got to execute this plan to bring inflation down, which I think inflation is starting to come off the peak. Employment, I think, is going to start to come off the peak. The question is, both of those are structurally going to be high for a while. So employment high and inflation high. So listen, they got to keep going. And I think as an investor, you got to be patient. And I know I said it last month on your show. I think the top part of my priority set is patience. And I think you've got to continue to be there. Hold high levels of cash. I would say the one thing, Jonathan, that we're starting to do, some of the high quality parts of the market, things like investment grade credit, AAA asset backs, with yields moving up this much, you don't have to take a lot of what we call down the stack risk, equities, high yield, and you get some real yield in portfolios. So we've been starting to add there. And the other thing that I think is really interesting, people are paying for insurance. I did a presentation yesterday. We talked about we're in the middle of a hurricane, and coming out of a hurricane, you want to sell insurance. That's what insurance companies do really well. Volatility markets are incredibly high. And as long as you keep your risk down, you can sell some volatility. And so we've been executing on some of that. I mean, these are incredible levels of vol, as you described at your opening.
Rick, just walk us through it. Is that an up in quality trade from high yield to IG, or are you taking that cash position over to IG? What are you doing?
So the first thing is we're holding our cash with both hands, and we still like holding a lot of cash. But, you know, we've been, and I know you said on the show with you last couple of months, we've been reducing the high yield exposure to pretty low levels. I still think that's the right place to be. And by the way, spreads in high yield are not cheap enough yet. I mean, they're still too tight. The thing we've also been doing is we've sold down a lot of loans. I mean, think about, you needed floating rate exposure for a while at the inception of a rate rise. Boy, the amount you've moved already, floaters are not that interesting anymore. I'd rather take high quality, you know, give me 2-year investment grade, 3-year investment grade, AAA securitized at 4.5%, 5.5%. Those assets are pretty good, and I wouldn't mind just holding on to those and high levels of cash for a bit of time, and let the market do what it's going to do while the Fed is tightening financial conditions.
Well, talk to me about what this market is actually doing. Is it easier to explain what happened on Wednesday or Thursday, or neither?
So, listen, I think it's easier to explain what's happening on Wednesday in that, listen, I think there are bursts of short covering that go on, and we got a bit of relief. You know, we talked about on a write-up that you could get a relief rally because people have gotten short in a lot of high-frequency trading has gotten short. And so you could see these bursts, and you see that in bear markets. You see bursts of rallies because people have gotten a lot of faster money has gotten to one side. But listen, I think at the end of the day, we're tightening financial conditions. The one thing I will say, Jonathan, is we've been spending a ton of time this week, and including my weekend coming up. There are some valuations in the equity market. I mean, this is one of those periods where people just sell, and because some points because you have to, and there are some valuations that are, you know, companies are trading at 3 times cash flow, companies that are just grossly cheap in a normalized basis. The question is, how patient do you want to be, and how much do you want to add, you know, without letting the market just do what it's going to do for a period of time?
Well, let's get to the punchline then. I've seen the numbers. Bank of America came out with some data this morning. Half of the NASDAQ more than 50% below 52-week highs, 77% of the index in a bear market. If there's somewhere you like in this equity market, describe it, Rick. Where? What is it? And are you acting on it?
So very, very slowly. I mean, and I'll throw out one that's controversial. You know, for first couple, I would say, gosh, I'm looking at a bunch of. Look at what got hit yesterday. Some of the autos, some of the home builders, some of these things are trading at. I mean, think about home builders at the multiple. But I think you got to be patient. So we haven't added a lot there. The one area that is a little bit controversial, because you have people who have to sell, is in software. And so we haven't really added a bunch. And but gosh, I got to tell you, I mean, you know, and you heard this from the CEO of Microsoft talking about companies are going to increase the amount of spend on tech because their input costs are too high, their cost of labor is too high. Software is going to benefit. And now you're getting, by the way, the multiples aren't cheap, but a number of these companies are going to grow at 25, 30% on a growth rate basis in terms of top line revenue, let alone EBITDA. And so, you know, you traded a 20 multiple now, not 40. And, you know, 20 multiple off of those sort of, you know, for some big names that are consistent cash flow, that are increasing implementations in the companies. So that's the place. But, you know, how aggressive you want to be today when you know people have to sell them, you know, I think you got to put one toe in at a time, if that.
And then cross your fingers. In fact, cross all your fingers, if you can. Rick, I need a final word on market functioning because I'm getting a lot of questions from Bloomberg subscribers about it. Walk me through what's going on in this bond market. Are you concerned about functioning in these markets before QT has even started? It feels like to me this Federal Reserve is starting QT, but really playing down what it actually means for financial markets, for financial conditions. Can I get your read on things?
So markets are functioning. I mean, I don't think there's any question. You can get done what you need to do. Do you need to be patient about how you execute it? Do you need to be deliberate in how much you do at a given point in time? When people are selling, do you have to be buying and vice versa? 100%. But listen, when the Fed drains liquidity, I know I've said this before on your show, raising interest rates has an effect. When you drain liquidity and the anticipation, by the way, if you look at actual liquidity numbers, they're coming off already. Some of it because of big tax payments that have taken place. People are paying their taxes. Liquidity is dropping in the broad system. Listen, that's something you got to pay attention to. I think you saw it in 2018. If you said to me, you know, which has a greater impact on how the financial markets work, it's liquidity. When you drain liquidity, and by the way, you've seen it play out this week when you've got levered structures, you've got sort of shadow risk that's out there in the marketplace, and that tends to, you get some things that break along the way. And so, listen, I think draining liquidity, by the way, when people say it's going to start in June, it's not really right, because you're actually seeing it underneath the surface and the anticipation of more to come. That's something that I think you got to be patient about. And then, like I said, start buying assets that are paying you for taking the risk today. Part of why I like some of these high quality AAA or single A corporates. Make some sense of or some of these equities that have just gotten so cheap that they're gonna rally at some point.
Hey, Rick. Awesome to catch up, buddy. Rick Reeder of BlackRock, breaking it down off the back of the payrolls report out about 40 minutes ago. Equity futures on the NASDAQ down 0.9% with your movers going into the open. It's Taylor Riggs.
And, John, I'm going to start with some downside movers as well. Hate to say it, supply chains coming and biting again. Take a look at shares of Under Armour, John, really falling here in pre-market, coming out and saying that they're having a really hard time securing inventory. And, of course, when they are, we should be able to pull up that chart. There we go. And when they are getting able to pull up the inventory, it's cutting into their margins by about 200 basis points in order to do so. Zillow, again, sort of another story. When we think about housing affordability, 30-year mortgage rates jumped yesterday to the highest, I believe, since 2009. So a lot of headwinds on the macroeconomic outlook. That's what analysts are saying for the forward guidance. Virgin Galactic also highlighting supply chain issues, saying that they're now going to be delaying the launch of some of those space flights until the first quarter of 23 because there's a labor shortage and a supply chain issue. Finally, I'll just end with some good news, I guess. Block, we know them as Square. We had Julie Sheriel over at Bloomberg Intelligence yesterday. The numbers were weak across the board. She came out and said better than feared, given the big sell-off as of yesterday. A little bit of a relief here today, John.
Taylor Riggs, thank you. Thank you very much. This equity market has been an absolute mess. Equity futures down about 0.8% on the NASDAQ now. The opening bell about 17 minutes away after some absolute carnage in the last 24 hours.
About what they call black soot caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now. We are dying slowly but surely, and our lifespan is reducing every day.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
Thursday's sort of sell-off.
It got hit really hard yesterday.
Not a good day.
I didn't expect a sell-off of this magnitude.
This reversal of the market's initial interpretation of the Fed meeting being dovish.
Taking the 75 basis points off the table.
We've already seen some
of the longer-term metrics reversing.
We're getting back into an environment where you do have to think there's consequences to what I buy.
I cannot keep up with these equity market swings on the S&P 500 or the NASDAQ. We have raised more than $1 trillion in market value from the S&P, with Bank of America saying the pain might not be over yet. Taylor Riggs has more. Hey, Taylor.
John, I think what is so interesting is the NASDAQ only had its worst day. Well, let me correct myself. The S&P only had its worst day since a week ago. That's how volatile this market has been. The NASDAQ, as you mentioned, though, a bigger story. Huge sell-off at one point off about 6%. We tried to close down just about 5% or so, but it is not pretty, and it was not pretty all across the board, as you can see there. Change up the chart, because this really shows the wild swings that we've seen. The 2% gains followed by 2% losses the following day. That's actually happened now 6 times in the last 7 weeks, and it didn't happen all that frequently last year. So that's showing the volatility pickup, the wild swings back and forth, the market really sort of not being able to figure out what it is doing. Go down the board again as well, and you can see sort of what's the defensiveness of this nature. We've talked a lot about the sectors in the red. Energy, of course, one of them. Communications, you're, well, not, I guess, doing a little bit better than expected, but sort of the reversal of what we've seen when you think about this week alone relative to where we've been for the year. Perhaps maybe digestion of some of the bad earnings that we got within the tech sector yesterday, catching maybe a little bit of a breather overall for the week. I think what you can see here, though, is when you think about sort of where we are in terms of all the big sell-off that we've had, the big e-commerce stocks here, John, Shopify, Etsy, Amazon, eBay, those have been sort of the big losers as we think about year-to-date performance. And it's been that earnings season that's really been a big digestion and looking at perhaps maybe some of the behavioral changes as well underway.
Taylor, thank you. Taylor with us through the opening bell. Once again, I'm pleased to say, joining us now, iCapital's Anastasia Amoroso, PGIM's Mike Collins, two of the very best on Wall Street. Anastasia, equities down, bonds down. How tough is this right now?
It is a struggle, John. It is a big struggle for investors. And unfortunately, I think it's going to continue to be a struggle, because the reality is, as good as the outlook is today, the future 6 months out is uncertain. And, you know, we've been talking about this since February of this year, is that in order for the Fed to fight inflation, they have to bring down demand. And I think that's what's increasingly sinking in on investors' mind, is that this is an economy that right now is sort of moving in a slow motion, but it's moving to a place that's going to be slower, to a place where rates are going to be higher. And all in, that means that earnings growth that we expect for the back half of the year may not actually materialize. So that's why, you know, you look at a payrolls report like we had one today, my initial reaction to it was, well, this is a just right earnings report, because it tells you the economy is still strong, there's job creation, but the wage pressures are starting to ease off. But you look at the market and there's absolutely no reaction, you know, that it's just right. The reality is there's very little risk appetite and, you know, very little appetite to guess around events, and people just want to play defense right here.
Mike Collins, this is really difficult. In the bond market right now, we're breaking out of the long end again, on a 30-year by 8 basis points, on a 10-year by the same magnitude. I'm really struggling, Mike, to read what's happening with the long end. I've had so many people come on this show and talk about maybe we've put a lid on things, on 10s, on 30s, then we break out again. Mike, what are you doing with the long end of the curve?
Yeah, we have really stepped aside, as we've talked about in the past, Jonathan, with regard to our interest rate posture and duration, right? There's so much uncertainty. Inflation is still really hot. The job market is still really strong. The U.S. economy is hot. The Fed is going to hike rates like crazy. As Anastasia said, financial conditions are tightening really abruptly, really quickly. Volatility in the bond market has been going up really since last fall, when the Fed first pivoted from dovish to hawkish. Now equity volatility is moving in the same direction, higher highs, higher lows, and we're going to see growth slow down, and the tightening of financial conditions is reflected in higher rates, higher spreads, higher mortgage rates, higher borrowing costs, and it's all part of the same story.
Until then, more volatility. Anastasia, for you, what are the conditions that are required for you personally to start thinking about allocating capital back to these big tech names, tech more broadly, the NASDAQ 100, the index, whatever, which has been absolutely punished year to date?
Yeah, John, a couple of answers to that. First of all, to think about it broadly, to be all in on the tech trade, I really think we need to have a Fed pivot. And that's nowhere close to being here in the cards because we need to see inflation peak, we need to see growth to stabilize, and the Fed can pivot them. But that's not where we are today. So if you look at the NASDAQ, for example, it's not dirt cheap yet. If you look at the S&P, it's not screening incredibly cheap either. So it's really difficult to step into the broader indices. But I will say, if you look under the hood, and if you start to look at the valuations of some of the individual tech stocks, a lot of them are trading in the bottom 20th percentile or below of their 5-year evaluations. So they're trading at the bottom of those 5-year averages. And I think if you can identify stocks in software and semiconductors, those are the most oversold and inexpensive sectors, then if you can identify the cheapest stocks in those sectors, ones that you like, you have conviction in, ones that are earnings positive, they actually have earnings to show for it, and they're growing those earnings at 15% plus, I think those are the stocks that you start to nibble on. And I loved how Rick Reeder said, you step in with maybe one toe. I think that's right. And that's kind of the approach that we're deploying here. But I'll take it one step further. It's not just buying these stocks outright, but what can you do with these stocks to monetize the volatility? Because if you look at the implied volatility on some of these stocks, it's in the 90th percentile or more over the last almost 10 years. So can you sell a put option on it? Can you collect a rich premium? And maybe wait for that pullback to eventually buy the stock. So I think there's creative ways to dip that one toe into the tech market here right now.
And Mike Collins, that's the equity view from Anastasia. Let's talk about the credit view with you just to wrap things up. When I look at credit, I look at the yields and I hear what Rick Reeder had to say from BlackRock. Things might start to get interesting for some people. Then I look at spreads, Mike, and I think maybe we haven't seen the damage just yet. Why are they still so contained? What's your view on things and what have you and the team been doing?
Yeah, I think it's the same story as Anastasia just laid out with regard to credit, right? There hasn't been enough pain yet, but that narrative I just described, Jonathan, is starting to really filter into the psyche of the markets. Pessimism is really starting to get priced in here. People are negative. I think they've taken down a lot of credit risk. We have taken down a lot of credit risk. People are short interest rates generally. I think the pain trade is probably lower rates and tighter spreads, but we are definitely starting to look for opportunities to add credit back. I mean, to your point, the credit markets have been really orderly. Spreads have not blown out by any stretch. Liquidity is starting to fray at the edges. But remember, the credit quality of these companies, as we go through earnings every morning, Jonathan, I mean, there are still more upgrades, more positive credit momentum. Yeah, profit margins are starting to wane a little bit, but the credit quality, the leverage in the system is really in good shape right now.
We're just overwhelmed by the fear that it won't be that way at the back end of this year. Mike Collins, good to catch up, buddy, as always, alongside Anastasia Amoroso. Two of the best on Wall Street. We've already heard from Rick Reeder. We've got more still to come. Mohammed Al-Arian joining us around the opening bell at 9:30 Eastern Time, 7 minutes away. Then on to the White House shortly thereafter. From New York, this is Bloomberg.
Energy prices and a short supply of key chemicals that produce synthetic fertilizers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertilizer helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down, the manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
From New York City with equities lower, here are your morning calls. First up, JP Morgan downgrading iRobot to underweight, expecting multiples to remain under pressure amid continuing supply chain disruptions. CLSA upgrading Melco Resorts to buy, pointing to the stock's attractive valuation. And finally, Piper Sandler downgrading Wayfair to neutral, highlighting a lack of catalysts and numerous uncertainties. Coming up, a conversation you do not want to miss with Bloomberg Opinion's Mohammed Al-Arian just around the opening bout. That opening bout is 4 minutes away, with equity futures down 0.8 on the Nasdaq, on the S&P down 0.6%.
The Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet Chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. Celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet Chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This has felt really bad. In many ways it is. But if I told you through the close yesterday, the Nasdaq 100 on the week was down just 0.03%. If you didn't know already, you probably wouldn't believe me, but that's the story. Futures all over the place again this morning, and good morning to you. The S&P down 0.6, the Nasdaq down 0.75%. There's the opening bell. Switch at the board and get to the bond market. Post payrolls, yields lower than higher, breaking out again by 7 basis points to 3.1%. Let's call it 3.11. In the FX market, euro dollar 105.83. That currency pair up 0.4%. The euro stronger as ECB official after ECB official today talks up getting rates up to zero and back above zero. In the commodity market, crude just short of 110, held 109.95, up by about 1.6%. That's the messy coverage of the cross-asset price action, or rather the coverage of the messy price action, depending on what you thought of all of that. Taylor Riggs has more. Hey, Taylor.
John, take a look at Amazon first here to start. I know that you mentioned for the week the Nasdaq's actually unchanged, but not so the case with Amazon. You're down 38% from a record high that we had last July, down 32% from some of the recent highs that we had right before that quarterly earnings report. So it's another sort of tough day here for Amazon. For the individual corporate results here, John, Zillow, of course, we mentioned this earlier, sort of the macro headwinds about housing affordability, 30-year mortgage rates now the highest since 2009. So really starting to see the impact from that. Under Armour really talking about the dependence, of course, on some of the Asian suppliers. Huge gross margin impacts here from some of the higher costs to get goods on the shelves. Peloton, John, this is an interesting one. We got reports after the bell yesterday that looking to sell off about 15 to 20% of a stake. MKM's Rohit Kulkarni writing out and saying that this alone looks like the restructuring of a necessary balance sheet relief has not yet come. That could be the impetus for this. Another big sell-off here, of course, underway for Peloton, and ahead of those quarterly results that we'll get on Tuesday.
Taylor, looking forward to the coverage of the close with you and the team a little bit later. Some of those names have been absolutely punished. On the West Coast, Bloomberg's Ed Ludlow just pouring through some of this, Ed. What a difficult couple of days.
Yeah, the word capitulation is already starting to make its way across the Bloomberg, right? We're down 0.6% on the NASDAQ 100, but size and scope, right? 5th straight weekly decline on the NASDAQ 100 as it stands. Worst losing streak since 2012. Powell gave tech stocks, particularly high multiple software stocks, a shot in the arm on Wednesday because he took 75 basis points off the table, a sigh of relief because higher rates discount the value of future profits on high multiple stocks like that on the NASDAQ 100. We're immediately changing our mentality to worry about recession fears from higher rates and the ability to deliver a soft landing. There's a really good note out, John, from Bank of America this morning pointing out that over the past 140 years, there's been 19 bear markets. And look, we're pretty firmly in bear market territory, right? That gave us an average price decline of 37.3% and an average duration of about 290 days for each bear market. Now, usual caveat, right? Past performance is no indicator of future performance. But based on current factors, today's bear market ends October 19th. And you're going to kill me for this, John. With the NASDAQ 100 at 10,000, right? 10,000 level. We're at what? 12,740, 1,240. The other bright spot is there's been a pullback in valuations. The NASDAQ 100 trading below its 5-year average price to earnings. I think we're trading at 21 times estimated profits. Where are the dip buyers? Where's the opportunity here? And we had Dan Ives on the tech show last night of Wedbush saying this is capitulation, but we are so bearish, so negative right now on big tech, we're bullish.
Hey, Ed,
what do you make of that?
That's the view from Dan Ives. He's been pretty transparent about how difficult that view has been over the last few months. Ed Ludlow there on the West Coast. We were conditioned to buy the dip because you were rewarded by it, by that behavior. If you buy the dip now, you get absolutely punished, and that's been the story year to date, really, on the NASDAQ and elsewhere. Joining us now, a man who really needs no introduction. Good friend of this program, good friend of mine, Mohammed Al-Arian. Mohammed, let's start with the jobs report and just start there because we've got a lot of work to do here. Your thoughts on what we saw about an hour ago?
Generally, a strong jobs report. I liked it. It means that the labor market is not going to be the cause of a recession or a significant slowdown. I just wish labor participation had gone up. It didn't. It came down, and that remains a major concern.
What are your thoughts about that, Mohammed, and why is that a major concern as far as you're concerned as we start to think about the inflation picture a little bit more?
Because right now we're dealing with supply-side issues, and the labor market is part of the supply-side issue. What we don't want to deal with is both supply-side and demand-side issues. And the longer we have supply-side problems, the greater the risk that we're going to pull down demand. And then we have both supply and demand problems. So that's why I'm hoping that we are going to be able to relieve some of the supply pressures, because otherwise they will in fact pull down demand. And how? Inflation. So that's why it's really important to continuously ask yourself the question, are supply side issues really getting better at a fast rate? And they're not, unfortunately.
Are you concerned that the situation that the Bank of England is confronting right now is in the Federal Reserve's future?
I am, and I must commend the Bank of England. I wrote yesterday on Twitter, I wish other central bankers were as honest and as balanced as Andrew Bailey was. Yes, he talks about a very narrow path. he shares the risks. He talks about the possibility of 10% inflation. He talks about the possibility of recession. And I think it's critical for central bank, independent central bank, to put out their best judgment that are not politically influenced. And I think the Bank of England is leading the way on this.
If I may, are you implying there's something the Federal Reserve is not being open or honest enough about?
Yeah, I worry that the Federal Reserve has tried to be too nice to markets, be it the transitory inflation narrative that lasted way too long, be it what happened on Wednesday. You know, you cannot come on TV and speak about all the uncertainties and then rule out a certain policy response, 75 basis points, and then give specificity to the neutral rate, 2 to 3%. We don't know what the neutral rate is in these conditions. You can't do these two things. Either you are honest with the fluidity you face and say there's a whole range of possible outcomes and we will continue to be very vigilant, okay? Or alternatively, you try to fool the market and it doesn't work because the market sees through it quite quickly, as we saw yesterday's reaction.
Two-part question then. One, and I think you've explained it, do you think it was a mistake to take that off the table, that 75 basis point move, even if they weren't intending to do it? And two, do you think this Fed, more importantly, has a credibility issue?
So it definitely has a credibility issue. It has a credibility issue with the American people, and that is why Chair Powell chose to address the American people at the beginning of his press conference. It has a credibility politically. Inflation is the #1 issue right now, and it increasingly has a problem with the marketplace in terms of, are they giving us honest forward policy guidance or not? So yes, there is a credibility problem, and yes, it was a mistake to rule out a certain action. We don't know enough about the path of inflation to rule out certain policy actions at this point.
Mohammed, I'm really concerned by some of the things I'm hearing from former Fed officials, including Governor Quarles, the former Fed vice chair, who said this: we would have been better served to start getting on top of it in September. That was hard to do until there was clarity as to what the leadership going forward of this Fed was going to be. Implicit in that is a suggestion that this Fed was late because they were waiting to see what would have happened with the leadership of this Federal Reserve. That's deeply concerning for a lot of people, Mohammed. I want your reaction to it.
So I took note of this, Jonathan. I took note of Rich Clarida's comments. I've been taking note of Bill Dudley's comments, many other Fed officials. It is fascinating to me how many former Fed officials, and I'm not talking about former in years, you're talking about former in months, are distancing themselves from this Fed. And it speaks to the credibility issue that you were talking about. It is absolutely essential that the Fed regain credibility. It will not do so until it does what the ECB did last week, which tell us why the inflation forecasts were so wrong for so long and how have you improved the inflation methodology. Unless it does that and come out honest, it's not going to be able to restore its credibility, and it's going to find more and more people very close to the Fed stepping away from the Fed.
Given everything you've said, is this connected to the mess that we see in this market over the last few days?
So the mess we're seeing in the market is about liquidity. You know, I'm willing to put my neck out there and say we've mostly priced interest rate risk. We haven't priced liquidity risk. We haven't priced credit risk. We haven't priced market functioning risk. We are still in the process of pricing it. But what we are seeing happening is liquidity risk. Liquidity risk is being priced in. And people are realizing that the days of abundant and predictable liquidity are gone. And now you have to manage to a much different liquidity paradigm. And that's why you saw yesterday, crypto got hit just as hard as, in fact, harder than other assets, even though people are looking everywhere for a diversifier. There is no safe haven in this marketplace. And that's what you get when you distort financial markets for so long, as the Fed has done.
Let's go through what you just said piece by piece. You said rate risk was nicely priced or fully priced. Given I know you've told us on this program a few times now that you think the Fed won't go as far as some people think they will. You said that credit risk was not priced, liquidity was not priced, functioning risk was not priced either. Can you go through one by one, Mohammed? Credit, liquidity, functioning. What you use to gauge that and why you think we're not there yet?
So credit is a function of what's happening to the economy, what's happening to corporate demand. And there is a big question mark as to how much demand destruction are we going to get. Right now, the marketplace hasn't yet embraced the possibility that we may see significant demand destruction. I hope we don't see it, but that's something to look for. Liquidity risk is the notion that not only is the Fed not pumping liquidity, but all the leveraging that happened on the back of that. And you see this in terms of outflows from bond funds. You see this in terms of margin calls, people being levered. You see this in terms of people want to get closer back to their home. The home bias is developing, and you're seeing this in terms of risk aversion. Even people who believe that there's significant value now in certain places are waiting on the sidelines. So we still have to navigate through liquidity risk. And the one that scares me the most is market functioning risk, because that one damages in a way that creates structural damage. So far, the pockets of malfunction have been relatively small, but this is, a tail risk that you really want to keep on the radar screen.
Well, something you've highlighted is just the whippiness, these big moves we've seen in the Treasury market. Mohammed, that's where there's meant to be a ton of depth, and we're seeing 10 basis point moves in either direction, and sometimes on days without a catalyst, almost out of nowhere. Is that evidence of the kind of concerns that you have?
It's certainly an evidence that you're getting patchy liquidity in the most liquid of all markets. And that's important because people have stretched for illiquidity risk, and they've gone to places that they seem to be liquid, but they are actually illiquid in normal times. And whether it's emerging market local currency, whether it's emerging market bonds, with certain areas of high yield, you're starting to get liquidity risk being priced more fairly. So yeah, it's a big deal. If the most liquid market in the world is subject to the sort of whipsawing we're seeing on no news, you should be paying attention to that.
What does this remind you of? Is there a parallel out there historically, Mohammed, that this reminds you of?
So it reminds you of episodes, and we've had quite a few, where the marketplace overshoots in one direction or the other, and then you get contagion, and then you get the sorts of behavior we're seeing right now, where you can divorce from fundamentals for quite a while until you reestablish the liquidity paradigm. So we have seen it, and we are seeing it now for good reason. That is, the Fed stayed in the business of injecting massive liquidity for too long and conditioned the whole marketplace to continue to expect it, and now that's going away.
How would you navigate this? I think a lot of people watching right now, Mohammed, listening to this, identifying the problems with Fed policy, the uncertainty about the future, the issues still to come down the road, credit, liquidity, market functioning, and looking at pricing again, the NASDAQ down another 1.8%, the S&P off by 1.3%. Looking to find out from you what they should do right now. What is your advice?
So it's hard to me because I've been saying for months, be careful, be careful. You will get better entry points, values being restored, but it's a non-linear process. The journey to the new destination may be longer than we expect, and it's not going to be particularly smooth, and that is what's playing out. Look, I would say if you're long-term investors, there is starting to be significant value in some names, but recognize that also the recent shift to passive means that you may be on the receiving end of selling that has nothing to do with that name. So you have to have an appetite for volatility. If you are significantly underweight risk assets, this is a time to slowly start buying. If you're overweight risk assets, I feel sorry for you because it hasn't felt good. And you may want to consider some reduction, even though it is painful. Look, the NASDAQ is down to over 23% year to date.
Yeah.
No one wants to sell at this point, but the reality is that look at what happened in the previous 2 years when everything was going up, and just be careful that we may have a longer journey to stabilization than we would otherwise. That is the cost of distorting markets. I'm going to come back to that. These markets have been highly distorted.
Well, Mohammed, you mentioned something on passive, and I want to go there with you. I think this is really important. We've had more than a decade of money going into passive strategies. Buy the index, sit there, nicely rewarded. That's been the story. Are you saying that we could face something like what EM has gone through periodically in the United States, almost on a global basis, because of the amount of money that's poured into that strategy over the last decade? Is that what we're going to unwind, something that big?
Yes, I think what people don't realize is when money goes into passive, it pushes up the prices of both good stocks and less good stocks. When money comes out of passive, because the managers have to sell across the board, you pressure good stocks as well as those who deserve to be pressured. So the good news is you're creating value. The bad news is that value is it's divorced from the fundamentals. So you've got to recognize, you've got to respect the technicals. This is an environment where the technicals, the liquidity technicals are right now in charge, and you've got to respect them.
Mohammed, it's been awesome to catch up, buddy. We've got a lot to talk about. I'll get in touch later. What a move we've seen in this market, and a lot more still to work out. Mohammed Al-Arian there, working through some of the market issues, the labour market data issues, and the issues still to come. Coming up, a conversation with the White House. That's next.
It's almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada, tapi nggak kayak dulu. Kalau dulu rame sekali, sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 tuh nyampe dapat jualan, bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu, sama aja. Belum ada turis ke Bali, masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
A lot's happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
We are about 20 minutes into this, and it's already pretty messy this morning, isn't it? Your equity market picture looks like this. On the S&P, we're down by 1.64%, down 67 points. On the NASDAQ 100, down by more than 2 percentage points. On a Russell, we're down about 2% as well. What a busy morning so far. Joining us now on Bloomberg TV and radio, I'm pleased to say, is US Labour Secretary Marty Walsh. Secretary Walsh, great to catch up with you, sir. Your reflection, your reaction to this jobs report this morning.
Certainly, it's a good jobs report. Anytime you go over projections, it's a good job report. We saw some areas in this in manufacturing and transportation, which the numbers are really good in, and seeing continued strength there. Retail numbers are very good as well, and I think what's exciting about that is the fact that, you know, when we think about retail, we often think about online shopping, and we're actually starting to see the in-store shopping stronger than it has been in quite some time. We're excited about that. I think these numbers that we come on here and talk about 400,000, 500,000 jobs, eventually we'll kind of revert back to a normal process here. I have not seen that since I've been Labor Secretary because we're recovering from a pandemic, but overall, 95% of the jobs that were pre-pandemic have recovered.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Down. We can't afford any type any type of bump in negotiation. I was in LA a week ago, and I think at the time I was there, we had 27 ships in the harbor. When I was there 3 months before that, there was 67 ships. So we're seeing a lot of ease of cargo coming into the ports. But we also, on the other side of the ocean, we're seeing ships lined up in China that eventually will be loaded and brought to the United States. So we just need to continue to keep our supply chain moving forward.
Secretary Walsh, we've touched on this together in the past. I want to do it again. What do you think the difference is between leveraging your position as a port worker with the union representing you and holding the economy hostage? What's the difference?
Well, I think it's important. My role as Secretary of Labor is important because I've literally negotiated on both sides of the table. I've negotiated on the labor side and I've negotiated on the management side when I was mayor of the city of Boston. And I think that it's not, you know, I don't need to get involved and we don't need to get involved in this negotiation unless we have to. And I think that anytime there's a negotiation going on in this country, it's always better to try and do it without a mediator or without somebody intervening, because it shows that both sides are committed to getting it done. I feel in this particular case on the ports of the West Coast, both sides are very committed to getting a contract done.
Secretary Walsh, I just wanted a final question about the release of the data and the process. It's not responsible for the prices on the screen. The equity market's been a mess the last few days, but it was responsible for some volatility around 8:30 Eastern time. As you know, the process for releasing the jobs numbers has changed somewhat. There used to be these lockups where you'd get the information before and the media organisations would sit on it responsibly, then release it at 8:30 Eastern time. That's changed. Now everyone's scraping the information off the websites, the internet. Of course, HFTs, web scrapers, people with that edge get the numbers then before, say, the retail trader. Can we reassess this? Would you go back over the process and have a look at it again?
Well, I know it was clearly pre-pandemic, but in this particular case, the way we release the information, everybody gets it at the same time. It's a fair way to do it. Every news outlet, from big news outlets to medium news outlets to small news outlets, get the same exact information at the same exact time. And I think that, you know, I think there was an evaluation here, and one of the results was that we're better off being fair than not fair. The people that had the ability to send people to this building and get the information, yet a smaller news outlet in the Midwest couldn't get here.
But they all release it at the same time, sir, at 8:30 Eastern time. That's the whole point. The problem is that when you release it on the website, not everyone gets it from the website because they don't get it as quickly as other people. Do you understand that? That other organizations, you can have a wider spread of organizations that can push out the information simultaneously without racing to the website.
Well, I mean, I don't know if racing to the website is a problem. I think that when you hit the website, everyone has the ability to get the information at the same time. If it's at this building, everyone does not have the ability to come to this building.
Okay, that's your perspective. Secretary Walsh, we appreciate your time, sir.
Thank you.
I know you're super, super busy again. Thank you for being with us this morning. Thank you very much. From New York City, that does it for me. This was the countdown to the open, and here's your price action. We are all over the place again. We're negative 1.8% on the S&P, down more than 2 percentage points on the NASDAQ. I can't keep up at all. In the bond market too, with yields higher at the long end, then coming back in, yields higher at the front end, now lower by 4 or 5 basis points to 265.71. Guy Johnson's going to take over things from now, from New York City. For our audience worldwide, this is Bloomberg.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s.
My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Businessweek about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari stores every day, also on TV, radio, newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employer's winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that